Today we're joined by Avi and Rishi, who have been training over 100,000 people in the United Kingdom on how to trade. And their success is led to them bringing back to communities how to train people, and they've run these programs across many of the communities in the United Kingdom. So we're honored to have them with us. And before we kick off, I want to share a brief story. And that is that in this week's Parsha in the Bible, we have the story of Korach, which is obviously very important because the first word in this week's Parsha actually means to take. And in life, the key, as I've said to many people I've come across who I've met and are sitting in this room and live streaming, like the Uber driver who took me to Luton Airport, who's dialing in now, or our friend who we just met at the bakery about 10 minutes ago, who said, I'd love to come and listen to this. Doesn't matter if you're Jewish or non-Jewish. We should always look out for each other. And to be a giver is a particularly important thing. And that's what this is about today. It's been giving people the ability to learn a new skill to trade. And the two individuals that are going to introduce you to this have been trading for over 14 years, have made a sustained living from this, and continue to give back to communities to help them learn this skill as well. So if you have any questions, feel free to ask. But I'm about to introduce Rishi, who will go first, and it's an honor to have him with us. Thank you so much.
Thank you. Thank you very much. Okay. Hello, everyone. My name is Rishi. I've been a trader for 14 years. But let me ask you guys a few questions, and for those of you that are online as well. Who feels that they are financially confident when it comes to things like trading or investing? Quick show of hands. Okay. Who's dabbled a little bit in it before, thought, I think this is going to happen, I'm going to put a little bit of money behind it. Has anyone done that? Okay. And who here feels nervous about it? So, sort of asking themselves the question, not sure if I should really be here today. Anyone? One person, good. So we've done these courses in front of hundreds of people, sometimes even thousands of people. And I'll be very honest with you, whatever you end up feeling here on the day or thinking, I guarantee you there is someone else asking themselves the same thing, whether it's online or in this room, and maybe they're just a bit shy to put their hands up. So what I want to do before we get going is I want you guys to make a commitment today. That commitment is, if you have a question, I want you to raise your hand and ask it. There is no question that we consider too stupid or too silly, or every question is a valid question. And if the chances are, if you have that question, someone else has that question. So could we all agree that if I have a question, I'm going to ask it?
Absolutely.
Yep?
Hands up.
Hands up, everyone. Actually, we get really, there have been events where, because it's sometimes finance, and you're looking at charts 3-4 hours into an event, you see people starting to fall asleep, like, okay, I've seen enough charts of the day. So we get people to stand up, but we're not going to do that. There's a nice group here today. So, and also if you do feel like, okay, this is a little bit too much, get up, stretch, get a drink. The most important thing here today is, it's not even that you learn everything that we're going to teach you. Chances, and the statistics are, the first time you watch something, you're probably only going to take away about 30% of what we're going to teach you here today. What I'm actually here to do is get that spark, get that interest in you and go, right, this is interesting. And number two, I can do it. I don't need to come from an economics background, or I've been doing this for X amount of years to start. And I do believe it is very important that people start. The main reason being, and we're going to go into more detail with this, is, well, and I think we were talking about it earlier, is they really do not teach financial sort of literacy in schools at all. And it's strange to me because surely that's one of the most important subjects that should be taught. Even basic finance, even I'll go one step back and just managing your debt against assets and just basic things like that. They don't teach it. It's not in, well, to be fair, it's not in their best interest to, because if you know it, now you have a leg up, right? Makes things easier for you. Whereas me and Avi, we've been in that world I've been in there for 14 years, Avi's been trading for 15 years, and we got to the position where we went, well, you know what? We should actually give back something. We both come from a sort of history. His granddad, my granddad, gave back to their communities. And we've been sitting here and you'd say, right, 14 years, it's been a pretty selfish career in the sense that I did it for financial gain. Pretty much did it for myself. I haven't really given anything back. And when I did give back, it wasn't my time or effort. It was just, here's a check and that's it. And we thought, wait, this is a great thing to do if we can give back to communities. And I think it is very important. But let's jump in. So this is going to be an investing course. You're not going to walk away from this course saying, I'm a trader now, or even a knowledgeable investor. But this is going to be more about investing.
May I just ask you?
Yes, absolutely.
Is this going to be recorded?
Yes. Well, I don't know if it's recorded or just live streamed. Yeah.
So we'll be able
And
to.
will be distributed and everyone live.
So we can review it. Amazing.
Great. So we've got a disclaimer here where you will sign your lives away. It's basically just a disclaimer saying you can lose money in trading and investing, And if you do decide to do that, you can't come to me and I'm not giving your money back. We are going to teach you very, very safe ways to do this as someone who's starting up. However, actually hands up and be honest with yourselves. Do you feel as if you have a sort of gambling mentality? It's definitely something I had in uni before I started trading. Yep, fair enough. And it's very, very important to understand that about yourself. Because I know, for example, in university, I definitely enjoyed a game of poker, enjoyed a game of blackjack. However, it is so important that you do not take that mindset into investing. It is so important. We calculate risk and we use probabilities. That's it. And it is also important, and we're going to talk a little bit about psychology in trading, that you be very honest with yourself about what your weaknesses are and your strengths are. Right, so we've been active in the market since 2007. We've helped thousands of people worldwide achieve their financial goals, passionate about helping our communities, especially in the last couple of years. Our aim is to provide guidance regardless of trading experience, and we've got a whole mapped out course for you guys as well. Our courses are built for you to become a knowledgeable investor and trader rather than just follow. We believe strongly in support, and we conduct a weekly support webinar free of charge for everyone. And that's really just to keep that momentum up. Make sure that you feel like you're part of a community of traders and investors. You can come on there, it's live, and you can interact with us. So if you have any questions, we find that the people that make a success of this come onto the support webinars. I've had people on there for over 6-7 years. They don't actually need my help at that point. They're very much doing it themselves. However, something comes up, they might learn just something they missed. For example, we found a lot of people coming on to these webinars when COVID hit because they had never navigated through that sort of a market. So they go, all right, well, what do you think about this? And then it becomes more of a discussion and a community. But at the start, I definitely think you guys should join this webinar because there'll be a lot for you to learn there. And it's only about half an hour a week. So we don't believe in just teaching. Investing, trading has helped us also achieve our goals. It's not just about learning a new subject and then that's it. This is a course about taking action. So that's me. I've been a lead trader at Become a Trader. I am the lead trader at Become a Trader. I'm a founder of Nangiotech, which is a data visualization company as well. So for those of you, and I assume here everyone either has a job or a business. So it's not just about I have to do this full time and that's the only way I can make this a success. I have a full-time business that I run with staff and clients and all that. I just make sure that I can fit trading within my timetable. 14 years, we've worked with asset management firms, we've taught thousands of people, and that's Avi, which will also introduce himself in the second half of the program. So, we used to do very large events. That's me on stage. We used to teach, sort of anywhere between 2-hour workshops, 3-hour workshops, online sort of hour webinars with thousands of people sometimes on them, and we stopped doing all of that. And that shift really happened in COVID. So become a trader. Has anyone ever seen these sort of companies that go out and advertise how to trade before? Right. So a lot of them kind of promise returns. And this whole market, they promise returns which I believe are unachievable regularly. Because that's what sells. That's what's sexy. If I tell you that, hey, I'm going to be able to, if you learn this, you should be able to make 20 to 25% year on year. And someone else is coming to you and say, well, all you have to do is follow our traders and you can make 100 to 200% a year. Which one do you think most people will go for? The 100 to 200%, right? It's not achievable. It's not achievable because the professionals that have been doing it year on year on year for 10, 20, 30 years, they don't achieve that. The Goldman Sachs of the world don't achieve that. So what makes you think you, as a retail trader, is going to be able to achieve that? What happens to those people is they blow their accounts. And that's what the whole teaching world around trading became. When COVID hit, we had to move online, and we saw a bunch of these cowboys online trying to sell their courses. And me and Avi had a conversation with ourselves, and we said, well, look, we don't come from a marketing background. We don't come from a sales background. We've been traders for 14 years. I don't really want to get involved in any of this. Why don't we just trade and do what we love doing? So that's what we did. So we stopped doing large events. We stopped doing those sort of webinars, and we just traded. There was an element that we really, really missed, which was the teaching element, the giving back side of things. So we thought, right, how do we make this work for us? Because at the end of the day, if me and Avi are going to put effort in, we want to get paid. It's just psychology. I'm not going to bother doing something if there's no return in it, especially things like trading. It's not just communities. There's loads of people will approach me and Avi and say, can you teach us how to trade? I'm not really going to bother unless it's worth it for me. But I didn't want to charge people because I believe financial restriction shouldn't be an entry point into learning this. So why am I standing here in front of you today? Why does this still work? And it's important you know that, because it's important you know me and what our motives are. We very simply get paid from the broker. So when you guys, and we only get paid from the broker, and this is what I love about this broker, we only get paid from the broker when you're there long enough, which means it's in our best interest and the broker's best interest that you don't lose your money. So without going into too much detail, brokers aren't always the most honest type of guys. They are after sometimes your commissions, and they're more interested in getting you to actually lose your money in your account than being there for a long period of time. Question?
What's the broker? Is that the person that buys and sells the stocks or the website?
We will go into that in the course. We will explain exactly what a broker is with a little bit of visualization for that. So that's why we're here in front of you, and that's why we've decided to help communities, and we do it for free. We don't charge for it. We go there, and you know what? We let the broker pay for it. And so we think that's a better win-win situation, and it allows us to get on a platform and continue doing this in front of as many people as we want. Right, this is another big reason why I believe people should be investing. Right now, especially in the last couple of years, we've seen inflation through the roof. Let me just ask you guys another question. In your lifetime, maybe not COVID, but in your lifetime, do you think you're going to see inflation pop up again? Yeah, you are. I mean, statistically, what is it? Every 10 years, something happens? I mean, so without going too much into why something happens every 10 years or you know, because at the end of the day, a lot of these guys, a lot of these bankers, a lot of these traders, they're trading client money. There's no personal thing. So they are actually more susceptible to risk than you guys, and they will take that. At the end of the day, when we have high inflation, the average person suffers. Because if we've got money in a bank and we're earning, you know, sort of 1.5%, and inflation at one point hit, 11%, you're losing money by keeping it in the bank. And chances are, you know, even if they get inflation down to 2%, I think they were talking that it's pretty much there, you're still not going to get that in the bank if you leave it in the bank. So you're still going to lose money. Maybe less than 9%, but you're still going to end up losing money. So to me, I mean, I tell people all the time, if you're just sitting there and you're doing absolute nothing, you're better off putting it in even a tracker. At least a tracker will turn at least 9% a year.
What's a tracker? I don't know.
Just follows an index. So a tracker is an instrument which you buy, and it just follows an index. No thinking, you just buy it for the long term. Follows the biggest companies. Trackers can track anything.
So
But
why do they do better than a bank?
because banks are going to be paying you, what, 1%? A tracker will follow, let's say you're following the NASDAQ. And so you will now perform as well as the NASDAQ's doing over, let's say, a 10, 20-year period. You usually want to hold it for a long time. Anywhere between, I would say, 10 years to 20 years. And rather than just holding money in the bank. It will be much, much better for your wallet. Right, so why this particular course? So we believe in a foundation for success. Starts with fundamental principles that every trader and investor must know for long-term success. It's expert-led. We've been teaching thousands of people. We've been doing this for a long time. Comprehensive coverage. We'll go from the basics, and the more you want to go into detail, the more you want to go into more advanced concepts, that's also available for you on our website, which you'll be part of and have access to. So there's a level of, okay, well, I've been doing this for a year or 2 years. What's next? How do I improve this? I really enjoy this, but I want to go to the next point. So you'll be able to follow a curriculum while going through this. I really believe in practical learning experience. That's why we've got you guys to bring your laptops, and we're going to be jumping onto the laptops today. Customized learning path. So one thing, by stopping these big events, we've been able to have conversations with the people that are learning with us. Very difficult to do in a big event. Everyone learns differently, and everyone finds difficulties in a subject at different points. Maybe the maths is the weak side, for example, or maybe discipline, or maybe it's the emotions. So the advantage of doing these smaller courses is that we get to customize that learning path with you. So if you call us, drop us an email, we will help you develop your trading learning plan. One thing I think is very, very important is you have to be adaptable to market changes. So learning core principles that work in the market over a long period is very, very important. We want to build a robust trading mindset, and we want to be able to get you guys starting immediately, starting the process, start looking at stocks, because that momentum is so important. I cannot tell you the amount of people that go onto our courses, they'll do a month, something will come in the way, they'll stop for 2-3 months, and they go, okay, I want to get back to it. They'll come back and they have to start from scratch. That momentum is so important especially at the early stages of your learning. So keep that momentum up. Use our webinars and use all the resources that are available to you. So how have we structured this day? We're going to be getting you to open up your live account. We've gone through, your savings aren't growing by 7%. Why invest and not trade? Yes, so this is also important. Why do we want to invest and not trade right now? Very simply, without going into it, it's your experience level. We are traders, we've taught traders. At the start, the best way to give yourself the best chance is to invest and let your profits speak for themselves. When you start growing that account, you'll gain more confidence. It's a slower process, it'll take some time, but prove to yourself that this is something that you can do, first of all, and want to do. What do you think happens to someone if they go, right, I want to become a trader? They learn for, let's say, a month or two, they become a trader, they blow their first account. What do you think is going to happen to that person? Do you think they're going to jump back into trading? Probably not, right? They're probably not. They're probably going to go, right, this is not for me, and that's the end of it. That's the end of their journey. That's what we do not want from you. We do not want you to blow a single account, not one. And that's why we start people off with investing. Because we're going to teach you very, very safe techniques that over the longer term will consistently give you profit and growth. And then, only then, once you've been, let's say, doing this for a couple of years and you're a bit more interested, you can move on to the trading side. But prove to yourself first that this is something you can do. Practice. I think it's pretty redundant. Practice is very, very important, and especially in a subject like this, or I believe in any subject you do. Any subject that you're actually going to apply, practice is very, very, very important. So we want you to treat your trading account like it's your bank saving account. So the only difference really is now you're in control with that sort of growth. We want you to take it that seriously. I want you guys, and if you can't see, come a little bit closer, because this is really the importance of compounding. So I'm going to just walk you through it. So our account size here is 10,000, right? So that's just giving an example. We've got £10,000 in our account size. Each month, our target is 2%. It's currently what we are achieving, anywhere between 20 to 30%. We've had sometimes better years, but that's an average. And where you've got here extra a month, we're putting in no extra capital injection into our account. Okay? Let's see how our account would have grown. So in our first year, we would have ended up from 10,000 to 12,700-ish. Let's skip forward 5 years. We would have gone from 10,000, and in about 5 years' time, that account would be worth 32,000. We'll go to the 10-year mark, and it will take you 10 years from that 10,000 to get to about 100,000. Okay, so first of all, who would be happy with that sort of return after 10 years? You put in 10 grand, and after 10 years, you get 100,000. It's not bad. It's a great return, really. If you're consistently able to make around 2% that month, for a month, now obviously that's an average. You're not going to do that every month. Some 6 months, sometimes the whole market is dropping, and then you'll get that back when the market pushes up. However, there are techniques you can do to fast track that. And that is, our first technique is we put in a little extra each month. I'm not saying it's for everyone. Maybe you can't afford to put in that extra 300. Maybe you can afford to put in that extra 100, for example. But look at the difference it makes in your 10-year. So same, you start off with 10,000 and you end up a little bit more in your first year, 16,000. It's not a huge amount more. However, in your 10-year mark, the difference is from 107,000 to 253,000. And that's just by adding in an extra £300 a month into your account. Okay? Still performing the same, still giving you that 2%, and that's the difference it makes. Compounding is one of the most powerful tools you can have. It requires time. This is Warren Buffett's most famous, most prized possession is compounding. He talks about it all the time. And it is so powerful. However, what discipline do you think you need for this to be achievable?
You need to just be consistent. So that if it's going down, just kind of keep going and not be getting stressed about it.
So with the consistency, you do need consistent. The consistency part is you need to consistently apply the strategy. There's not much we can do about the market. The market's going to do what it's going to do. But you do, yes, have to be very strict about keeping consistent with applying the strategy. But you also have to be incredibly disciplined to not pull your money out. And that is hard sometimes. Sometimes you go, oh, well, I've got an extra 15 grand here. Let me just pull that out and use it for this. Have your goal in place. I would say this is great on paper, 10 years. But in my plan, I actually have points in which I take out capital. The reason I do is because I very much believe in you rewarding yourself for your hard work. And sometimes just seeing numbers is not going to really feel so good, but every so often I might take out 15, 20 and buy myself something nice or use it towards a house or whatever it is that you want to use it towards. But that helps me go, right, I'm going to keep on going, I'm going to keep on going. Question.
What you see here is sort of when markets it's relatively stable, right?
No, not at all. Not at all. This is just an average.
Now, I understand, but in terms of inflation, I mean, my background is geopolitical risk, so it's likely that markets are going to become increasingly volatile because of the risk in the world. And as a result, inflation will go up dramatically, like we've never seen before. So even though you're compounding, the only thing, will it be below the rate of return that you would need in order to
beat inflation?
Yes.
But it depends what inflation is. I'll tell you now, if the UK stands at anywhere near even 6%, even 5% inflation, year on year, we've got big, big problems. There is no way the Bank of England will let that happen. There is no way we're going to be, in the next 10 years, if you see inflation at 5%, we may have spikes. We may go, something's happened geopolitically and we've got a spike and we weren't expecting that. But Bank of England's target is to that 2%. And one thing this country is very good at, we have a very good Bank of England. I know people sort of go, oh, they're not great and look at what's happening. I'm telling you, they are very good. We've nearly got inflation down to 2% again. That's them. We have excellent economists in this country. And I would not see inflation being anywhere near consistently that 5-6%. So yes, we would be beating inflation. Okay. And in terms of, and it's a good point, you know, how can you consistently get 2% a month? What if the markets are falling and they're aggressively falling? Well, an example of that is COVID, right? How do you think trading and investing did to date from COVID? Good or bad? And yet, hands up if you think it would have been quite bad throughout COVID period. Hands up if you think it was good. It was phenomenal. Yeah. It was not just good, it's the best I have had in 15 years. In some of the stocks that I've been able to get into.
Because people have more time.
No. So what happens in a crisis, and we'll go through it when we go through a chart, what happens in a crisis? People panic, and it's not even that. Banks go safe. Investment banks go safe. We want to be in cash because we want to see what happens. You know, if they have a 20% drawdown, if you're sitting at a Goldman desk and you have a 20% drawdown, you're fired. That's it. You can't have a 20. You get 10% drawdown, your account is halved as a trader. So if I'm sitting on a Goldman desk, I'm trading, I'm 10% down, my account's halved. It's very difficult for me now to get the bonus I want. And if it goes down 10% more than that, you're fired. No, you know, this is being recorded, so I do have to say I don't know exactly what the Goldman's rule is, but generally in the investment world, that's how it works. So for us, if we see a 20% decline, 30% on decline on our stocks, we're not worried. It's our account. It's fine. We can actually get in when the market's falling, and we'll go through that when we go through the strategy. But for us, that push back up is you know, we would way overachieve the 2% a month. So again, it's average. You're not going to get years like we've had in the last couple of years, but on average, you might get a year where you make 15%. The next year, you might make 35% because the market outperformed. So it's just an average. Right, so let's have a look at the next one. If you can, for example, maybe, let's say for the first couple of years, you're putting in 200. Year after that, you go, oh, this is working quite well. I'm growing my account. I can see that this account is growing. I'm going to put in 300. And you gain the confidence into the system. And you go, right, I'm going to put in 500. Well, look at the difference in year 10. Exactly the same, except from now you're making 3%. So you've got a little bit better. You're picking maybe a few stocks which are doing well. For example, maybe in the tech sector right now. And you end up, or maybe you do a little bit of trading as well, and you get an extra % a month. And you end up with 3% a month. It's not unachievable. An average of 36%, 30%. It's high, it's a very good return, but it's not unachievable. There are traders out there that get it. Look at the return you've got from a £10,000 investment after year 10, nearly, well, just over 900,000. right? But forget that slide. I don't even want you to think about that slide. That is what I'm just showing you is possible. But right now, we're going to focus on sort of here, moving from this compounding to that compounding. I want you to get the confidence to go, right, I want to add money and grow my account. That's what you want to focus on. Just know that the end goal can be well worth it. Okay, so this is the Warren Buffett approach. I'm just going to read it out. Warren Buffett, Berkshire Hathaway. Has anyone heard of Berkshire Hathaway? Right? Just one of the most phenomenal investment companies out there. Has delivered remarkable performance over the decades, showcasing the effectiveness of the value of his investing approach. From 1965 to 2023, Berkshire Hathaway compounded annual gain was approximately 20% compared to the S&P 500's 10.5% over the same period. Now, Berkshire Hathaway takes much less risk. So I'm going to do a very little exercise to get people engaged. I've been talking for a while. What I want you guys to think about, if you had a trading account, what is the percentage you would be comfortable to lose? What is the percentage you would be comfortable to lose before going, right, this is not for me? Think about it. Because I very much doubt it's going to be 100%. I would like 3%. So if your account went down by 3%, you would say, I'm done. Okay, fair enough.
It would depend. If it was right at the start, I put my 10k in and I was losing anything, then I would think it's not for me. But if it was further down the line and I'd made something, then I'd be prepared to lose more. So it would depend on
Interesting. So it depends on what happens earlier on for you. So if I'll come back to that because that's a very interesting point.
What's your perspective?
I was thinking around 5%.
Okay. So that's very interesting. So so to give you an example, I said an investment fund has about 20% it can play with before investors are more likely to pull out their money and put it into another fund. Okay? So
I was thinking about 30 to 40%.
Yeah, that's fine. 30 to 40%. That's probably where I sit.
And that would, again, probably echoing what the lady said over there, it wouldn't be at the beginning. It would actually be, in the beginning I would want to see stability, but I would sort of, as you mentioned also momentum, I would understand the fact that there are going to be highs and lows, and that I would make it back. It would be just part of an ongoing dynamic, rather than something that was random and haphazard.
You'd be pretty unlucky to see that straight from the start, right? Like 30%.
Yeah.
However, the market is the market. And what we're going to teach you today is there will be cases where you will 100% be down more than 3% at any one point. 100%. It's going to happen, for example. It's 100% going to happen. There will be times when you're in a trade and or in a stock and 60% of your stocks or 70% of your stocks are down because the market's down. And when we move into the strategy side of things, you'll see that actually it's about following the strategy, but it's also about knowing where that threshold is for you. So the reason I'm talking about this is because you may ask, well, annually, Berkshire Hathaway made 20%. How can we hope to make 20%? They actually take less risk. The more money you have, the less risk you take, because you don't want to see whipsaw in your portfolio, in your performance, right? So the more money you have, the less risk you take. For us, we have to sort of get to a point and go, well, how much am I willing to risk? And the only way you're going to know that is sort of understand what could happen, what's the worst case scenario, understand the strategy, and go from there. but we'll move on to risk a little bit later on, and each and every one of you will have a different level of risk. Each and every one of you. I might be happy with 30%, but that's because I can hold 30%. And being happy with 30% means when I'm down 27%, I'm not sweating still, I'm still going, just as I would.
Depends about the appetite for the risk you have.
Absolutely.
What trajectory you are in your investment plans and your investment goals. Like 5% of 10,000 is a lot less than 5% of 250,000.
Absolutely.
So you'll tolerate a lot more in the early, but you
Correct.
won't tolerate much later on.
Correct.
Or
That-
the
that's why
inverse. Or the inverse.
No. Most of the time
I would tell people never the inverse. The bigger your account, take on less risk.
Take on less risk because at
Get
one point
your
you want to
account
exit.
stable.
At
Get
one
your
point you
account
might want
stable.
to exit.
What?
altogether.
But the question is, bigger account is different to different people, right? So it's all. Some people, for example, the first time I hit £100,000 in my account, that became a big account, and I lowered risk. But now it's not. So I'm okay to take a little bit more risk on 100,000. Whereas first time you get to 100,000, you might go, right, I want to really make sure things go safely and grow, and I'm happy with 30,000 extra a year from this. But then maybe after 10 years, you'll say, well, actually, I want to get to that next step. So
It's a forever changing dynamic. Okay, so and this same strategy, this exact same approach that Berkshire Hathaway uses within his fund is the one we're going to talk to you and teach you today. It's the value average. So he's a big fan of blue chip stocks. Does anyone not know what blue chip stocks are? Okay, so blue chip stocks are big stocks, big companies out there, the names that you would have heard, the Nikes, the Disneys, the Teslas. They are big companies, and he's a big fan of buying those companies, the ones he likes, when the market's going down at a better value. And as it goes down even more, he buys even more. And that's what he does. Right, let's jump into the stock market, because I think I'm running a little bit behind, right? A little bit, yep. Right, fine. The stock market is a collection of markets and exchanges around the world where we are able to trade stocks of publicly held companies and see issues of new shares of publicly held companies. The leading stock exchange found is in the US, and they are the New York Stock Exchange, NASDAQ, Chicago Board Options Exchange, so CBOE, and oh, we're missing. No, we're not. Okay. Does anyone know what an exchange is? Has anyone ever heard the term exchange? Yep.
Yeah, but I don't know what it is.
Fine. An exchange is a basket of the largest stocks and shares within a country or a particular stock exchange. So
that's an index.
an index and not exchange, an index. So remember earlier I was talking about index funds and just following an index. And you can just buy an index. So an index is a basket of the biggest stocks. So it could be the FTSE 100, for example, is the 100 largest stocks in the UK. The best way to track any stock market around the world is to track the corresponding index of that country. So generally speaking, if you come onto our webinar, first thing I'll do is I'll look at the index and I'll see how the market is performing overall, generally. So if we wanted to analyze the investors think of the economy is doing in the US, we would study the Dow Jones Industrial Average or the S&P 500. It gives us actually a very good indication about where investors' heads are. So if we're seeing the NASDAQ rise and the Dow Jones go down, we know investors technically not technically, just generally in the US are more enthusiastic about the future growth of tech stocks, which is exactly what happened in the COVID period. We saw a huge push in tech stocks. So, market movements. What drives the market? Stock prices within a free market change purely because of supply and demand. Supply and demand rule prices always. It determines prices, and nothing is different in the stock market. So, what is demand? Well, that's when you buy a stock. When people are buying a stock, that's known as demand. Selling a stock is known as supply. If there is more demand than supply, very simply, prices will move up. If there's more supply than demand, prices will move down. This is just some terminology we want you to get used to. We use it a lot on the webinars. We talk about demand in the market. We talk about supply in the market. But we won't go too much into detail. We've got full videos on the website which talk about supply and demand. So the US stock market is bigger than all other stock exchanges around the world. This is a major factor why many investors choose the US stock market to invest. This in turn drives many companies to want to list on the US stock market exchange, even foreign companies. The US stock market's normal trading hours are Monday to Friday. So for us, between 2:30 to 9 p.m., or if it's GMT +1 at the time, then it's 3:30 to 10 p.m. These are quite important times because those are the times that you can make any decisions on your stocks or make any changes. So maybe the better question here is, why should the US stock market be important to you? Very simply, opportunity. Has anyone ever, just out of interest, anyone ever looked at, for example, the FTSE 100 versus the NASDAQ and seen how it's performed over the last 5 years? Just a side-by-side comparison. I'm going to show you guys today.
What's the Nasdaq?
It's the biggest tech stocks in the US. So trading or investing in the stock market gives a chance to own a small share of the company that we already may have heard of or we use in our everyday lives. Stock markets are here to stay, and they've been here for hundreds of years, giving us a sense of confidence that the market will be here for many, many years to come. And the US stock market is where we predominantly focus our attention and our capital behind, and it's not even close. I can't even find another stock market that closely resembles the growth that we see in the US stock market. There are endless opportunities every day to invest or trade, no matter how much time you want to spend. And this is so true. It really comes down to how much time can you spend. In my life, I've gone from being an active trader to looking at charts which change every minute, to a point now where I'm busy, I run another company, I have employees, I have clients, and I only get to spend maybe anywhere between 20 minutes to half an hour a day just checking my stocks. And so it really does, the opportunities are there, and time should not be a limiting factor. If you say to yourself, I only have half an hour and I want to spend half an hour, then set yourself that half an hour, and I guarantee you, if you do that half an hour every day, you'll be able to still benefit from what you're going to learn here today. So what I want to do is, that's enough theory for now. Let's jump onto some charts. And I want to ask you guys a question. So the first thing we're going to do, is it it's not visible. What happened? Turn that, let me. Okay, can you guys see the chart? Yes. Okay. So, where is... Right, let's go through this chart. So, at the bottom here, you'll see we've got months and dates. This is representative of where price is on that particular date. So for example, if we were to look back here at October, well, let's go March 2023, we're looking at Adobe here. We can say Adobe on the right-hand side. If you look over here, we've got Adobe was at $321 back in March 2023. So at the bottom here, you've got date, and on the right, you've got price. Okay? That's actually probably the most important thing when looking at a chart. Is that clear before we move on? At the bottom, we've got date. On the right, we've got the price. Okay. Now, let me zoom in. Where's my zoom gone? Let's just zoom in that way. Okay. Abby, do you know where the zoom button is? Usually I have it on the bottom right on my computer here. But it's squashed in. Oh, yeah. Okay, so this is called a bar chart. Each of these bars represent a certain amount of time. That time is decided by what you've clicked up here. So can you guys all see I've got 5, 15, 30, 1, 4, and D. Yep, can you guys see that? Just at the top here. 5, 15, 30, 1 hour, 4 hour, and daily. Whatever I pick there is what is represented by a single bar. So by one bar. So right now I'm on the daily chart, which means if we take this as an example, this is the movement of that particular day. If it's green, in that day, it finished higher than when it opened. If it's red, it finished lower than when it opened. Is that clear? Okay.
Sorry, if green, it was what?
If it's green,
Yeah.
the market finished higher than what it closed higher than it opened.
Yeah.
If it's red, it closed lower than when it opened. So in other words, the market went down. Ooh. And that's really the main basics of the chart. You've got price, you've got date, and you've got what each candle represents. You've got a few numbers here, but we'll go in through that when we go through the chart. We've got this. Again, we can go in through that when we go to the chart. So, okay, great. So what I want you guys to do now, we're actually going to come back to this. We're going to look at a few particular stocks, and I want your opinion. So this is Nike. I want to go back to 2023. Now, if you were to look at this, I'm just doing a little exercise because we're going to come back and apply the strategy to this. Do you think this is a good stock to invest into? Had you invested, sorry, let me rephrase that. Back in 2000, if you were in 2023, so if you were all the way here in 2023, and actually, forget it, let's see, I want you to know what happened afterwards, but let's say you were here back in 2023. Would this have been a good stock to invest in, even though you know what's going to happen to it? The market's gone down.
Oh, so initially?
Initially. No, just right now. If you were in 2023, if you could go back into time, and you're in 2023, would you say that Nike would have been a good stock to invest in 2023?
I think you would have felt a bit
Why?
of disappointment in the next 4 or 5 months as you see it. It shakes a bit and then it careens down.
I would say if you were just
In the
sitting
long
there.
term.
I thought it was no. It's not a good one.
No.
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 Because
not.
you want something low that will rise, not something that is high that will go down.
Exactly. But the difficulty in that is, just a quick warning, using terms like low and high, subjective. We never know what's high and we never know what's low. If I showed you NVIDIA 10 years ago, you would go, oh, it's making new highs. It's at its high. And then it went flying up 10 times that. Or Tesla, for example. So we never actually know if this is high or low. However, what we can confidently say is, since 2023, it's gone down, right?
You might have thought in 2020 you didn't know it was going to go down. You might have just seen it going up, and you might think it's going to continue. How would you know?
Exactly.
That's why I said yes. I thought this was
Might have, but it didn't,
yeah.
right? But it didn't.
No, which-
But you wouldn't know.
yeah.
We're going to come back to each of these stocks, and what we're going to do is apply the strategy that we're going to teach you here today and see how that would have performed.
Should we just only at 2023 or should we be looking at the trend subsequently?
I only want, at this point in time,
Yeah.
I only want you to go, right, had I invested at around 2023, would I be up or down right now? I'd probably be down, not a stock I would traditionally get into. Right? So what we're going to aim to do today is sort of break you out of that retail mode of if things are going down like this, it's bad. If things are going up, it's bad. Actually, we want to teach you how to make money regardless of what the market is doing. So what I actually want you to do, whatever your opinion was, put a little note in your notebook, write down Nike, bad or wouldn't invest. We're going to come back to this a bit later on. The next stock I want to look at is...
Sorry, just to what extent does fundamental behind the price movement go? Like Nike gets a new CEO, or they file a patent that takes it into a new market.
It's continuous.
So you could expect the price to increase, surely.
Maybe.
There's a lot more to just the price movement, the historical price movement. There's always
Well,
the potential for
price movement...
corporate actions and the fundamental.
Potentially, yes, but price movement will reflect any fundamental shift.
Yeah.
Price movement is the absolute indicator of where the market thinks it's fair value given all its fundamentals. So at this moment in time, Nike is at that, even considering the potential of any changes that are happening to Nike, according to the institutions, because it's the institutions that are investing. Yeah, and that is reflected on price. So price is what we call the absolute indicator because it's the truest indicator there is. So all those fundamentals, and we never know, any company any day can say, we got this new discovery and price goes flying up. Or they could come out and say, we've done a horrendous, we've had a horrendous problem and whatever happened and price has gone down, right? That could also happen. Or our factory here has, there's been an explosion, something's gone wrong, and now we're out for X amount of time. But funnily enough, the strategy we teach you takes that into account. So I'm going to show you something. So I'll go to a very obvious one, right? And this is just to mainly show you what's even possible. Do you think this would have been a good stock to invest in? You know what? We'll go all the way to even July 2023. Here. Yeah, looking at where current price is, you would have been, oh yeah, this is a... However, at this time, you would have been sitting here, you would have had a good year of the market pushing up all the way from $11 in 1 year's time to $45. How do you think the retail trader reacts to that? It's high. It's high. It's the highest it's ever been. It's done 3 times its value this year. Chances are it's going to come down and I'll buy it when it gets cheaper, right? It's natural. It's at its newest high. However, we also want to make sure we get into situations like this where we are able to get into the trade if we can. And, NVIDIA went from, let's go down here, $20, $11, up to $127 in the matter of 2 years. And that's throughout COVID, when most people were thinking, weren't even thinking stock market. Whenever there's a big sort of move around the world or some big shock around the world and the market crashes, that is the time when most people with financial experience are thinking about, what do I want to buy? What do I want to get into? Things are going to be a lot cheaper for me to do so. It happens. We see it every 10 years at the moment. Right, the next stock.
But when you speak about getting into a trade,
Yep.
when it's in that upward climb as you saw, how would you get into it there?
We're going to go through that when we go through the strategy. I don't want to go ahead because I'm going to have to teach you.
How we get in, what do we do if the market falls, what do we do if the market goes up. But we're going to go over these exact same stocks again, but we're going to apply the strategy and walk you through what we would have done throughout this entire process. The next one I find very interesting. It's something that has given us actually pretty decent return. However, I'm just going to start it from here. Right? From here, so again from around 2021, would Tesla have been a good stock to get into? from 2021. So from this high, if you're sitting at it now today, would you have been happy with your purchase in Tesla? Probably not, right? Cool. So traditional investing, we would have not got into this. I just want to get you to write that down because it's going to be very, very cool, I would say, when you actually see how the strategy applies to any of these stocks and how it would have performed. And then we're going to invite you to come up and think about any stock you want, and we're going to apply that strategy and see how it would have performed. Any stock you want. And I'm going to pick one for you, which is the next one, which is BlackBerry. Does anyone know what happened to BlackBerry over the last 7-8 years?
Virtually non-existent.
Right. A stock, by the way, we were investing in at the time. So this is what happened to BlackBerry. Okay. We went, and this is new, so let's go back. Did way worse than this. Let me switch out to a monthly. Right, so BlackBerry went from, this is BlackBerry's chart, back from 2008. So you're sitting at what, $140-ish? And then we had a big decline all the way down to about $2.50. You're not going to be happy with that. If you bought there and the market went, oh, kiss your 3% goodbye, that's you're looking at nearly 100% wipeout on that particular trade, right? So, and the truth is, if you were sitting at, you're watching BlackBerry at that time, there is no way you would have known that was going to happen. If you did, you would have made a lot of money going short on this. Yeah, you would have made it. So I'm not going to sit here and say, I thought, I knew that BlackBerry, this would happen to BlackBerry. I'm not going to say that. In fact, I was buying BlackBerry at that time. Yes? Well, you can sort of go, WhatsApp's coming out, no one's using BlackBerry Messenger.
What happened to BlackBerry with Steve Jobs?
Fine.
They weren't listening to their customers.
Sure.
And you could see the trend moving to Apple, moving to full smartphones.
Yeah.
And there was a lot of talk at the time that I think the CEO at the time said consumers don't want music on their phones, they don't want good cameras, they just want a business phone.
Sure.
And I thought at the time, no, you're wrong. That's exactly what consumers want.
But based on that, on your point, in terms of investment strategy, to what extent do you factor in the conversation on the street? Because I remember that time, I loved the BlackBerry actually, because I liked punching things down.
So did I. Didn't like touchscreen, I hated it.
Hated it. I liked punching it down. And most of my friends were telling me, you're mad, right? And you saw it picked up with Apple and Android, everybody was talking about it. So to what extent are you informed by not simply charts, but narratives that you hear on the streets?
Not even a little. Because I'm
If
telling
you
you,
were, you could have said,
Well, you don't know because we made money on BlackBerry and we were buying. So we'll show you that when we go into the strategy. But it doesn't matter to me. All that matters to me is is your company going to punch back? I don't care if you win. Are you going to fight the free fall? That's it. That's all I care about. And when we move into the strategy, you're going to find this very interesting, how you can make money off a stock that did this. Buying, not selling. We were buying. And how did we make money on this? But there are rules. We have rules. For example, and we'll go into this in the strategy, but if a market, if the If something drops by an X percentage within a certain amount of time, we step out. That's too big of a drop for us. And we will walk away from a company which resembles this. But the problem is, what if you're in the trade? What happens? You're sitting here and BlackBerry is still one of the strongest in the world, and that's great. The thing is, you analyze that and you sort of came with your logic and that panned out. You're not going to be able to do that in all the companies you're investing in. You're not going to be able to. You know, there'll be some things that you are interested in and you'll spend a little bit extra time and you go, but you might be investing in a pharma company which you know nothing about. And it's a big, it's AstraZeneca, but how much do you read about AstraZeneca and what they're doing? And you go, right, I don't agree with this. It's not your speciality, you don't know. Doesn't mean you don't invest in it. The strategy allows us to not know as much fundamentals about where it's going to go. We just need to know, and this is why we invest in big blue chip companies, are you going to fight that free fall? Are you going to punch back? Because when you punch back, you see this. And that's all we kind of need. But we'll go into that when we go into the strategy. So again, I want you to write down BlackBerry. No, I wouldn't have invested. Most of the time people look at this and they go, thank God we didn't get into it. And I'm telling you, we did get into it and we made money, and Avi's going to show you how we did that. Right. So actually, do we want them now to get their accounts and so they can log on, or should we continue a little bit? Cool, we'll do it during the break. Yeah, quick show of hands.
I have
You've got, so who's got an ActivTrades account?
do I have one?
Yes, you've got one. Okay. Great.
During the break,
We'll come around and check everyone's. Yeah. Great. Do you all have a Become a Trader account? No? So that's something we can do in the break as well then. Yeah. So that's where all your videos are going to be. This is where we'll go into all of these topics in a lot more detail. And you will all have access to that as well. Right, we're going to get into a little bit more juicy, which is fundamental and technical analysis. I've heard these words been thrown around here a little bit. Some people have been talking about fundamentals. Let's talk into it a little bit more. Okay, so fundamental analysis is the analysis of a company's finances to determine the company's intrinsic value, also named fair value or true value. This value may or may not be the same as the current market value of the company. What's the time? Yeah. Go on. Let's take a 5-minute break, stretch our legs, and we'll get back to it. Yeah. If you have any access the market. So you've got traditional stock market trading. So traditional stock market trading is the most common way we know how to invest or trade in the stock market. There's only one way investors or traders were able to access the stock market in the past. Until spread betting was created by brokers. Now, has anyone here heard of spread betting? Okay. Does anyone here think spread betting is riskier than traditional trading or investing? Anyone? Wrong answer. Yes.
I think it is.
Yes, it definitely can be. It absolutely, definitely can be. And that's why understanding risk management is going to be very, very, very important to you all. It's what I would say the most crucial thing when it comes to trading is understanding your risk. So, spread betting, the harshness of the word betting can divide opinion until we understand a little more about the product. So, first of all, the reason, and I'm not just going to go through the text, just a bunch of text, but basically, the term betting allows you to invest and do it in a more tax-efficient way. So because you're technically betting, it's a loophole, you don't pay capital gains tax. If you were investing, you would pay capital gains tax. But because you're betting, you don't. All you are doing is simply betting a certain price, and Abby will go through how we do that on the broker, and there's loads of videos on our website about it. But what you're essentially doing is you're betting in a direction and then how much you want to bet. And you make a deal with the broker to say, right, if it goes up, and when I get out the trade, you'll pay me if I'm buying, but if it goes down, I'll pay you. And so, with spread betting, think of it just as you would conventional investing, especially for now, because in spread betting you have the option to buy and sell, but we're not even going to get into the selling short or going short part of trading yet at all. That's going to come a bit later in your journey. So think of it just like traditional investing. You buy a particular stock, right? Traditionally, you would buy a particular stock. You'd call your broker up and say, I want to buy X amount of stock in Google, right? And then they'll say, right, that's the price. You'd pay that. You're doing something a little bit different here. What you're doing here is you are actually betting on the direction in which that stock is going to go. So you're going to say, right, I want to traditionally buy, but what you're doing here is you're making a deal with a broker. You're doing it in the same way. It's a click of a button. You're clicking buy. But what's happening in the background is technically you're not buying anything. You're just making a bet with that broker that if the market goes up, and when I get out, if it is higher than the price I bought it at, you're going to pay me. And if it's lower, I'm going to pay you. Right? And the amount is determined by what we call trade size. And when we get into working out trade size, etc., that will become a lot clearer. But for now, all I want you to think about it, it's exactly the same, but we are going to utilize spread betting accounts and investor accounts because we need a little bit less. One of the benefits from it, this is why I might utilize spread betting at times when it comes to investing, is it requires less margin. But realistically, for now, when you're starting off, we want you to do things as safely as possible. So actually, we don't want you to use margin at all. So margin is sort of borrowing money off the broker, but we don't want you to use any of that at this point in time. Right, so why trade or invest in a different way? So I like ActivTrades. So ActivTrades is the broker. They have lower barriers to entry by allowing clients to invest in partial shares. So the beauty of ActivTrades is you don't have to buy a full share. You can buy partial shares. Traditionally, you would have to buy at least one stock, right, to get into a company. You can't buy half a stock. But when you use spread betting brokers like this, you can actually buy half a stock. They also pay dividends on your stocks and shares. So if you're holding a stock, let's say for 6 months, and you are due dividends, traditionally in spread betting, because you don't own the stock, you don't get paid dividends. However, there are brokers out there which will pay you dividends on a spread betting stock. And you might be thinking, oh, this is exactly what I thought the first time I heard this. Well, how can they do that? How is the broker actually doing this? How is the broker being able to do this? So on the broker side, there are, and I'm not going to go into a huge detail into this because it can take some time, but there are two things the broker can do. The broker can either take the other side of your bet. So they can act as the other party of that trade and say, yeah, whatever, we'll take the other side of this person's bet. Chances are, most people that trade or invest on these sort of, using spread betting, lose money. Chances are, he's going to lose money. I'll take the other side of the bet. If he wins, I'll pay him. If he doesn't, I'll pay out. But the reason that these guys can pay dividends is because they don't operate like that. They don't have an A and B book. That's what that's called. What they do is they take an aggregate of the amount of people that are buying their stocks, and they actually go and purchase the stock. So they'll balance their books. That's how a traditional broker is meant to do it. That is actually how they are meant to do it. This new wave of brokers which kind of take the other side is something that they started to do when they realized that, hey, people are just out here gambling. So we'll take the money, why are we passing it on? However, the reason why we took our time and sort of partnered with ActivTrades is because with our clients, everything we teach you is about longevity. Because we know the moment you're out the game, you're out the game for good. You're never going to get back in it. You're going to say, nah, I lost my money, it's not for me. 90% of people that happens to never get back into trading or investing. And it's a shame. So for us, it's about longevity. We don't mind if you make 5% in your first year or 1% in your first. It doesn't matter to us. As long as you're in the game, you don't lose your account and you slowly, slowly get better and better. It could take a year, it could take 2 years, it could take 3 years. This is not a sort of quick race to the finish line. So there's multiple things that we like ActivTrades for. They're obviously FCA regulated. Does anyone not know why that's important? Anyone? Right. Okay. So FCA regulation is the FCA is the body that makes sure that the broker is doing what they're supposed to according to the regulation. If they are not FCA regulated, you are not protected under their umbrella, which means, for example, if a broker goes bankrupt and you've got money in their account and the broker goes bankrupt, that's it. You've lost your money. If they are FCA regulated, they have to keep your money in a separate account. They can't keep it in their account which they use for their operations. They have to keep it in a separate account, so even if they do go bust, your money is safe. And ActivTrades, when me and Avi have been doing this for years, so some of our clients have more than the FCA, what the FCA protects against, which is I think 75,000 or 80,000, somewhere around that mark. ActivTrades offers insurance on up to something like 3 million if you want to. So for those people that have larger accounts and as you grow with them, they'll be able to insure you for the full amount, even outside of FCA. But they are FCA regulated, which that is your number. Look, at the end of the day, you might be starting off with these guys because these are the guys that we've partnered with, but this is a journey that's going to be with you for the next 10, 20, 30 years, however long you continue investing. There will be times where you'll go, right, I want another broker to do something else or whatever. It's up to you. That is the one thing it has to be. I don't care if it's whoever it is, I don't mind. But FCA regulation is something you have to have in the broker you put your money in. Otherwise, if they do not have that, please do not put your money in that account. That is so important that it is FCA regulated. Okay, now we're going to move on to risk management. This is this is a super, well, to me, it's the most important part of trading, is risk management. There's a very popular saying amongst traders, which is one trade is never going to make you rich. Well, very unlikely, to be honest. But one trade can ruin your account very easily. Very easily. So let's have a look. Positioning. So first of all, there's two ways which we look at risk in terms of investing. It's a little bit different for trading, but for investing, so long-term to medium-term investment, there's two risk elements. Number one is your sectors. So which sector does the company you're investing in fall within? You never want to be just in one sector. Okay? And again, we've got a whole video, I believe, on different sectors on our website, which will go through a little bit more detail about why this is important. But you can have sector shocks. So, for example, you could see the banking sector go down and take a hit. Or we could see We have in, what was it, 2009, or 2007, when was it? The technology bubble, right? The dot-com bubble. So you'll see particular sectors be hit by certain impacts around that sector. So what we like to do is, let's say we have 20, let's go to positioning, which is links in. Positioning is all about what to get in, okay? So that first one is, what do we get in? We want to make sure that we have what we call a balanced portfolio. And then as you get a little bit more experience, you can put a little bit more money within the tech sector, the banking sector, mining, whatever you want when you get a bit more experience. But right now, you want to have a balance. So I would say I would never let my portfolio go above 20% in any one sector for now. So let's have a look at another point, which is when to get in. So you've got positioning, you've got what to get in, when to get in, and the last one is how much to get in. Right? They're your three important questions when you're looking at your position size, so actually getting that trade open. So let's give an example. Let's say you start with an account size of 20,000. Okay, you've got an account size of 20,000. Now, we want to be able to get into enough diversification amongst these sectors. So let's go, right, I want to get into a total of 10 trades. And actually, I would probably say that that's where you should start. If it's the first time you're doing it, work with the number of, I'm going to allow myself to get into 10 trades at any one point. And then you can play around with that as you go, and we'll teach you a little bit more about having more.
Sorry, what do you mean by account size 20,000? What is that?
It means you've got £20,000 in your account. Okay, so you've decided I want to trade or I want to invest, and I have £20,000 that I'm willing to try this with. Then it could be 10. I would probably say 10 is where like the minimum I would say that you want to be able to do this with. Anything less than 10, you're going to start to struggle a little bit to get into stocks, and you'll see why. Mainly because we only trade the US markets. Actually, I went before that. Let me just, sorry. I wanted to show you guys the difference. So we only trade the US markets, and it can be a little bit expensive. Okay. So this is, okay, we'll take it from 2015, why not? This is the FTSE 100, right? Oh, let me just go to another. Okay. So this is the FTSE 100, so the UK index, the UK's biggest 100 stocks. This is why we don't even bother with UK stocks anymore. So this is from 2008. Let's just take this. From 2008, how much has the FTSE 100 gone up? If you just bought and hold the 100 biggest UK companies, you would have made around a 19% increase. Okay, maybe a little bit more. 20% increase. Right? Since what year did I say? 2010. Right? Does anyone want to see what the Nasdaq did? Let me show you what the Nasdaq did. Let's go. That's the Nasdaq. Okay, that has gone up since 2000 and whatever. Did I do 10? Oh, let's go do 11. Whatever. That's gone up 825%. Why are you bothering with UK stocks? They do not move like the US market at all.
When people say in the media critique on the previous government that there's not been much economic productivity, is that what they're is that what they're referring to?
Absolutely. The stock market is an excellent
indicator of growth, right? It's an excellent indicator of how much our companies have grown in value, which is essentially what this is. We don't even come close to other indexes and stock markets out there. Not even close. So if you're an investor and you have the potential for your stock to grow, would you rather, just seeing what's happened in history, go, right, I'm going to pick UK-based stocks, or I'm going to look at US-based markets where, yeah, maybe I will be able to just 99% of my stocks, I'm going to get out with my target, but we could have an NVIDIA happen every so often. And it happens more often in the US than any other country.
And what contributes to the fact that in the US it's much greater growth than in the UK? Why is it? What are the contributing factors?
There's a lot. Innovation is a huge one. They have a lot more
In
money.
the US than us. So they pump money into their companies. I mean, the amount of money they put into innovation there. I mean, just think about how mind-blowing, how market-changing, I should say, Tesla was. When Tesla came out, how did it change the world? If you go back and honestly go to yourself, 10 years ago, 12 years ago, you thought there'd be a big craze for electric cars. When the concept of electric cars was there long before Tesla came out, but when they came out, they marketed it in such a way that they drove a frenzy behind getting an infrastructure. They went around the world installing Tesla chargers, for example. Apple takes the world. Which companies can compete? There are companies out there, but most of them are based in the US. And I would put that probably down to they chuck money at things. They throw an unbelievable amount of money at things to get it going. Even if you look at COVID, to kickstart their economy again, they did what they did best. They threw money at it. And even they had problems. But to me, the US market is not even comparable. And the UK market, sorry, is not even comparable. It's not even my second favorite. I don't even look at it anymore. I used to maybe about 10 years ago, but I stopped looking at it because I thought, what's the point? There are times, like I also bought Tesla stocks pre-split. That's never happened to me in a UK stock. I've bought UK stocks before. They just don't have the legs that US stocks have historically had for me. Not to say the UK can't get there, it's just very unlikely. I very much doubt it. Amazon was one of those great ones, which for the first time, I remember when Amazon came out and everyone was having the discussion that how are they making money? They're still a loss-leading company. They're making losses. This is crazy. It's never going to work. It's going to blow up. It's never going to work. I remember this about Amazon. This was the conversation we were having amongst traders and people in the finance industry. And they set a completely new model for that world. We have who else did it? Netflix. Netflix, perfect example. Facebook did it. Yep, Facebook.
Well, they just threw money at it.
No, so essentially their whole thing is a loss-leading company. You gain traction, you gain followers. And for example, for Netflix, they became a marketing tool, right? So this is where marketers could now use. So they lost, but get the users on board. You're not going to use anything else but Amazon anymore. You're not going to use anything else but, what's the other one? I was thinking of? I think Spotify was one. No one's going to use more than Spotify anymore. Well, they tried. There were other. I think Google tried to compete. There was Tidal. But so loss-leading. Netflix is one of the best examples of loss-leading companies as well. Americans are very, very good at doing that, and their investors will back it. It's very much a startup hell as well. There are a lot of companies that people put money in and go bust in the US. Way more than the UK. But that's why we focus on only the blue chip stocks. We're not trying to gamble on those penny stocks or anything like that. So the strategy we're going to teach you does work across different assets. You can pick UK assets if you want, but I really enjoy, and it's been very rewarding for me to pick US stocks. Purely because it can do what Tesla did and it can do what NVIDIA did, and I don't plan it. I don't know that it's going to do that, but it can happen. So, sorry, going back to this example. So let's say you've gone £20,000 in the account. You're going to take 10 trades in total. What we're going to do is we're going to say, right, total available for a trade is 2,000. Does everyone follow me up until here? Right? I've got 20,000 in the account. I can take 10 trades. The total available for a trade, we can think of a trade as a stock. So total available for the entire stock is 2,000. Total positions taken, 8. We're going to explain this when we go through the strategy. So what this means is, as the market is going down, this will be a little bit clearer in the next section when Avi goes through it, but when the market's going in one direction, we're going to allow ourselves to be able to get in up to 8 times into that particular stock. Okay? So we're not going to just get in once with the 2,000. We're not just going to go, right, I want to buy 2,000 pounds worth. We're going to get in 8 times. Okay? This will become a little bit clearer, well, a lot clearer, once we go through Avi's section. Which means, just at face value, that's £250 per position that we can get in. Okay? This is just an example of risk management. Don't worry if this is what we're going to follow. This will become a lot clearer. But do you see how it's very clear? We know what we're going to get in, when to get in, and we know how much to get in. Nothing is left to our sort of interpretation of the market or what we feel like getting in. It has to be set out in front of you in terms of a strategy. Okay? And guys, honestly, all of these slides are available on our website. There's videos of them, so don't worry. So if I'm taking 8 positions from 2,000, that means each position value will be £250. So I've got a total for a trade of 2,000.
Yeah.
I can get in 8 times.
Okay.
So very simply, 2,000 divided by 8 is 250. That means if I get in £250 worth 8 times, that equals 2,000. But don't worry about this. Avi's going to go into this in a lot more detail. The purpose of this slide is to show you that you have to have a set of rules which you follow. You are clear what you're going to do. And it's not left up to your emotions, or you go, right, how do I feel this is going to go right now? How much do I want to put in right now? Everything is calculated. So at no point is there a surprise, or I'm not left with a position where I go, I don't have enough money to get into the stock that I'm supposed to get into. That is one of the worst case scenarios you can do in investing, is you know you want to get into a stock, the market goes against you, you need to get into that stock again, but you've used that money somewhere else. That is one of the worst positions you can get into, because now you are not following the strategy. Okay, I'm going to move on to the last section for me, and then Avi is going to go into the strategy, which I want you to follow along on your computers for the strategy section. I want you to get used to using ActivTrades, but I'm going to go through psychology within trading. I would say trading psychology is about 80%. Oh, I see. I'm ruining the mic. I would say trading psychology is about 80% of trading. It is something which I have seen destroy new traders. Because again, if you lose your account, it's very unlikely you're going to start trading again. And you're going to be battling trading psychology throughout. I'm going to go through some of the common trading emotions you may go through. Greed. Could someone give me an example of maybe where you envision greed being a problem that could come into your trading? A scenario.
You're making a profit and you think to yourself, I'll just keep running this, it's going to get better and better.
Absolutely. The most common one, and it's absolutely true. And I guarantee you will go through an element of that. I have gone through all of these, personally, all of them, multiple times. It's about how you control it. I am much better than I was when I first started in my first year at controlling this. But greed, I guarantee you, you are going to go through an element of that. 100%. And you're going to go through, and I'll tell you why this is a problem. Let's say you're sitting there and you get into a stock and it goes up higher than you thought it was going to go. And you stay in it. And you make more money than you thought you were going to. I would argue that's a bad thing. Because what do you think you're going to do in the next stock? You're probably going to hold on to it. And investing is a game of probability. If we calculate that on average, stocks go up by this much, then we will move that take profit. But there is a reason that we get out when we get out. And so I have seen one of the most dangerous things to happen, and it happened to me my final year of trading. I got very lucky. My final year of university, I got very lucky. I was quote unquote trading, but I was gambling really, and I made something like 400% just spread betting something random. And I got so overconfident, and I thought everything I was doing was right, and I pretty much nearly wiped out that account. I lost like 60-70% the next year after. But I knew nothing at that point. I was, in university. And I found actually when I look back, it was probably more dangerous that I made that 400%. And I kind of wish I didn't. And I kind of wish I lost money at the start, because it would have pushed me to learn the correct ways earlier rather than get overconfident and go through the wrong path. So greed is definitely something that's going to happen. Hope. Where do you think hope could come into a negative aspect of trading?
After a loss, or
Yeah. Not even after a loss, it's before the loss. It's the dangerous one about hope is, let's say you're meant to get out of a particular stock because you hope it's going to go up. So in regards to investing, because we don't really make losses because it has to go all the way down, but let's say that we've got really big news coming out, and I'm talking monumental news for the company, and we're stuck in a loss, right? And it's very rare that this will happen, but me and Avi may tell you, guys, we're going to get out with this small loss. We're not going to leave it. It's very rare that will happen, but let's say there's a monumental shift. If you hold on to that hope and it continues down, then that can have and will have a huge effect on your P&L, overall your account balance. The biggest example I've seen with hope, it's not going to be you're not going to go through it too much right now when you're investing, but in trading, I have seen really horrible examples of people holding on to hope. Me and Avi were in Singapore once, and someone we were teaching, and they introduced us to someone, and they said, "Can you help us with a trade that I'm in?" And me and Avi like, "Okay, I don't know what we can do once. How can we just help you with a random trade? But sure, we'll have a look at the position you're in, and we'll see what we can do." And this person had been holding, I think it was a pound-dollar trade, if I remember correctly, or something, and they were down 50%. They were down 50%. At that point, what can anyone do? And that's because she was hoping it would turn. And she could have easily been out with a 1% loss or 2%. In trading, we teach a 1% loss. So when we're trading, we have a very, very strict amount we're risking. But, and at that point, that's incredibly dangerous, because there's nothing you can do at that point. You can either close it and that's it. If you lose 50% of your account, it takes you much, 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 much longer to get back to your 100%. So let's move on to the next one. Fear. Where do you think fear could hinder you in your trading? Or investing, I should say. I would probably lean with, let's say you get into your first stock, you're very excited, everyone's very excited in their first stock. So they get in, they buy their first stock, and the market goes down. So they're down a little bit. It's fine, they know it's normal. They go in, they find another opportunity that we say on the webinar, we're getting into McDonald's, which we are very close to getting into. So, and it goes down. The third trade, they get fearful. And then we go on the webinar, we're getting into NVIDIA. They don't take it. because they want to see the first 2 stocks they get into make money first. But the nature of trading is we don't know when those 2 stocks are going to go up. There could be fundamentals at play which, okay, those 2 stocks are going to be like that for 3-4 months. But the third one we get into goes to our take profit and we're out. Now your performance and our performance are very different. And it's because of that fear of not getting in. I understand that being cautious is very important, because I would advise you all to be cautious, but going back to this, understand your rules and stick to them. These aren't the rules you're going to follow. Abby's going to go through the exact rules you're going to follow, but understand your rules and follow them. Frustration is, you know what? Frustration is something which is incredibly common. They will kick you off the trade floor when you are feeling frustrated because you make bad decisions. I remember I had a week where I think it was about a week where I missed, basically my entries missed by just 1 point the entire week. I had a lot of trades that just missed my entries, and the ones that I did get into made me a loss. And I was incredibly frustrated, and I found myself on that Friday making a mistake. And I ended up taking the next 3 days off just because I was frustrated. The one thing I would say is when you come to trading, have a clean, calm mind. Do what it takes to get to that point. Following the strategies will help, but make sure you're in a space where, you know, if you've got kids, maybe the kids aren't running around, shouting around you. Maybe whatever it takes for you to get into a nice, calm space, because you do not want to make a mistake by accidentally adding an extra 0, which I have done. I have, instead of, let's say, going in at £10 a point, I've accidentally gone in at £100 a point. And that's something you really want to avoid, because you might not pick it up that you've gone in at an extra amount, and then that could go to a loss. And then you're like, oh my God, instead of losing 10%, I have now lost 100%. It won't get to that because the broker will let you know first. But still, so be calm, check your numbers, and we're going to show you how you can check each and every time. Abby's going to show you something on the broker that you are going to check every time. And that's, you know, how much you're going to lose and how much is being taken up. But frustration can sometimes lead to you just going, oh, I'm just doing it, and continue with your day. Because life does get in the way, and we all have things that we need to do. So take your time. Be in a very nice, whatever that is for you, whatever your relaxation space is, or wherever you can focus. That's the word, focus. Okay, so I'm going to go through an investing cycle. Yes, I'm going to go through an investing cycle. This is how you're all going to start off. You're all going to start off with unrealistic optimism. All of you. It's going to be unrealistic, and you're going to be optimistic, like, yeah, you know what, I can do this. It's going to go from excitement, thrill, go through euphoria. And when you get to that point, and you get to a point where, I mean, this could last a while, by the way, especially in investing. In trading, you hit this cycle a lot quicker. But in investing, this could be a while, depending on what the market's doing. If the market is just slowly doing this, well, our strategy works very well when it's slowly doing that and going up continuously. This might be there for a year or two. But at some point, when the market is doing something you're not used to, COVID was a great example for our clients for that. When the market went, and some of these stocks went down 30, 40, 50%. Me and Avi are very calm. We're like, great, soon will be money-making period. We just have to time this now. But you'll go through anxiety, denial, fear, maybe even depression. Maybe you'll be sitting there and you go, I grew this account to 20,000. It took me a year, and I grew it to 20,000, and now that account's only worth 15 or 12,000. The market's crashed, and it's only worth, I've lost X amount, 50%, 40%. You haven't lost it. You're still in the trades, but the market's gone down, so the value of your stocks are less. You might even go into panic. It's the worst. But yes, you might go into. This is when I would say make sure you definitely are coming on the webinars. But eventually, you'll be trading or investing for enough time where you'll go through acceptance, understanding, discipline, relief, and you'll get to a point where you have realistic optimism, right? It's very, very exciting the first time you're getting into it, but over time you'll realize it's a process. It's not exciting. It's exciting when you see your P&L grow. Sure, that's exciting, but the process doesn't need to be exciting. It really doesn't need to be. It is once you find a little love for it and you go, right, this is actually very interesting, but it will take time. So just know that if you do find yourself in any part of this investing cycle, it's normal. It's normal, and you just have to make sure you get yourself out of it and into the next step. And sometimes the answer to this is time.
I'd be excited merely because I was competent, right? That I know that I'm understanding it, right? Not necessarily that I'm good at it, but that I'm understanding it. If I would worry if I got thrilled. If I was thrilled, then it becomes a bit of a spendthrift gambling thing.
All right, I call bullshit, and I'll tell you why. Everyone is thrilled the first time they get into that trade and it goes to profit. I was. I still sometimes am. You are that thrill of, hey, I got into something and within a day I made 1%, which would have taken a year or half a year in a bank. I did it in a day. That is thrilling, no matter how you look at it. But it's about getting that thrill out. It's about it becoming norm. It may not happen, and I feel that, okay, great. If it goes the other way first, good. That's a good learning curve. But that thrill, don't feel like you failed if you go through. Don't feel like you failed if you feel any of these things. I'm telling you, it's a normal part. If you don't, look, I love what I've done for X amount of time. There were definite places of thrill, and that's part of it. All of this is part of it. But actually, what's important is none of this should make a difference on the decision you make. But feeling it, it's normal. It's normal. Hey, look, I'll go to trading. You know, if I've had and it rarely happens, but if I've lost 5-6 trades in a row and I'm risking 1%, and do you think I'm going to feel, I'm not going to do anything of it, but do you think I will feel an element of fear, depression, or panic? Yeah, I probably would. I'm not happy I'm down 5%. I'm not happy I'm down 5%. I'm going to be a little bit panicked. Oh, God, I hope this doesn't. But I follow the strategy. And so I'm allowed to feel these things. You're allowed to feel all of them, actually. Just don't let it affect your decision making. But I'm just telling you, expect it. It doesn't mean you failed. Right, so this is where you are. Motivation versus knowledge. You start off in step 1. You're at high motivation. You're like, yes. Motivation. You've got all that. You come off these courses. You start looking at the stocks. You sign up to the broker. You might even make your first trades. You've got high motivation, low knowledge. You will then move into low motivation, low knowledge at some point, which means, oh, okay, I saw the compounding chart and 10 years seems much longer than it looked on that chart. And it is going to take me 20 minutes a day, and that seems like it's a long process. So that motivation comes down, but the knowledge is low. The most important step is getting to this point. This is probably the longest step. Getting your knowledge, building your knowledge, and that includes the experience of getting into these stocks. But eventually you'll go from 1 to 2 to 3, and the best place to be is when you hit 4, because things are happening. It's like riding a bike now. Investing is. It doesn't change. The rules don't really change over that time, really. And I can just do it when I have 20, 30 minutes a day, and I can continue that. I just have to monitor. I just have to place a stock every so often and continue that. Investor profile, know yourself. So on the course, we do go through, we don't have time today, but you will have to understand yourself. And that is very, very important. I want you to know what your strengths are, your weaknesses are. Are you able, hands up if you're able to follow rules. And the truth of this is, actually, we are all able to follow rules sometimes. But it's sometimes, right? It's not always. Depends on how bad the punishment is. That's what it is. Have any of you ever been caught or ever sped in the car? Right. So that's not following the rules. Because the consequence, right? But if there was a police officer behind you, chances are you're going to be driving the speed limit. Right. So it's the same thing in trading. Once you start understanding the consequences of you breaking the rules, you'll stop breaking the rules. And I've done this personally. A lot of what you're seeing here is mine and Ivy's personal experience. Because have we broken the rules in trading? Yes. What were the consequences of it? I lost money, so I won't do it again. And it's not just losing a trade, I lose an amount of money I shouldn't have lost. Sorry, yes.
In every discipline,
Yes.
the person who is really great is somebody who's mastered the rules and then they've broken them on their terms.
I call it bending.
Whatever you call it. Right?
I'm allowed to bend the rules.
These are people who are innovative.
Yep.
How is it possible? It's one thing to sort of be enthusiastic in the rules, in the sense of being mundane about it, right? At what point and how is it manifest? Can one bend the rules, and how would they bend the rules to really be that Warren Buffett?
But when you understand
Consequence of bending that rule. When you first start off trading, you don't know the consequence of breaking your rule. Right? So if we give you let's give you a risk management rule that you're following, and you go, actually, I want to put a little bit more money into this. The question I want you to ask yourself is, what is the effect of that rule that you're breaking going to have? It's absolutely okay, and this is why I call it bending the rules. It's absolutely okay to change almost any of the rules, slightly, but you have to understand what the consequence of that bend is. And then you can analyze and say, right, is this worth the risk or not? But until you understand what the consequence of breaking that rule is, I do not want you to break a rule. Because I don't know what rule you're thinking of bending or breaking, and that could lead to you losing a lot more in your account. So I will always go with a blanket rule. Right now, you're starting off your journey. Do not break the rules. But just like in your careers, as you've been there for 4, 5, 6, 7, 8 years, your experience will allow you to understand what you can do and what you absolutely cannot do. So, yes?
If you know what your profile is, can you do some sort of assessment?
There are some assessments online.
Does anyone recommend?
I'll get back to you. There were some that I did like 6, 7 years ago, I think. There's a few books out there which I can recommend as well. Market Wizards was one that I read a long time ago.
What is this? Is this about assessing what your profile is?
I want to understand my profile better. Because if you understand yourself better, not only helps your trading, but also how you deal with life and difficulties.
Any situation, yeah. It's helped me a lot. Market Wizards is not necessarily just about profiles and understanding yourself, but it does have an element in there. It's just a general good book that I point people towards that are going to trade. Do you remember what that one by Chris Ward was? Trading Athlete. Yeah, Trading Athlete. Now, I honestly believe that just these 2 books alone is probably enough. I've read more than that, but a lot of them talk about the same sort of concepts. After that point, I would say, do you know what? Actually, I've had a really good idea. And I'm going to try it when I get home, and I will let you know. But I reckon I could build an investor profile by using AI. So if we ask AI and then I get you guys to feed your information onto it, it can probably tell you what your investor profile is. It will ask you a bunch of questions. So what I'll do is I'll make a prompt and I'll send it out to you guys. It's given me a great idea because it is actually very good, and it will use online resources in terms of what generic investor profiles are. But the hard part about investor profiling is you have to be very honest with yourself. And then if you don't realize that you're someone that gets fearful, or sometimes you are someone who procrastinates, then it's going to be very difficult to build that into your investor profile. So you have to be very, very honest with yourself. And actually, this investor profile is something that continuously changes in your life. It will continuously change. It's fine. That's just part of it. How do you handle stress? Anyone got any things that they turn to when they're stressed? Yeah? Make sure you understand how you handle stress. Make sure you understand how to relieve that pressure, because I don't think there's a single person in the world that will tell you trading and investing cannot sometimes be stressful. It can be. So make sure you do know how to do that. Same with how do you handle frustration and how do you handle losses. Right. So we're not doing the trading side today. So, no, fine, that's fine. So I'm going to finish off now before I pass it over to Avi. Trading. So we've spoken a bit about, investing, but also trading is a tool that you can utilize once you have proven to yourself that you can indeed invest. You've got the core values in investment, risk management, this, that. Once you can follow those rules, then you can move on to trading. Now, trading is a much more faster machine. It's a different beast. Everything happens much quicker. You're buying, you're selling. And it's a great way to boost your monthly return. So our target, again, is like 2 to 4% a month, I would say. I'd probably go 4% total investing and trading is what I aim for. But it's very, very active. You can make money when the market's going up. You can make money when the market's going down. You can lose money when the market's going up. You can lose money when the market's going down. It requires a much higher level of discipline. It requires a higher level, a knowledge level, and requires much higher levels of risk management. So,
could you just give an example of how you make money when the market is going down?
In trading?
Yeah, you mentioned before how BlackBerry, how you made money.
So Abby's going to go through that. So in investing, how we made money when the market was going down.
Yeah.
Trading is different. In trading, we can just very simply sell when we think the market's going to go down. I'm not going to jump into the strategy of that. For example, we will find that there is a level where a lot of sellers have come in the past. There's certain things we look for in the chart. When the market goes there, we can sell off. So if you are interested in that, I go through that every Wednesday on the webinar. Jump onto the webinar. We do half the webinar on trading.
At what time is that?
The 6 o'clock starts.
To what time?
6:30, 6:40, depending on if there's questions. Yeah, they're recorded as well, so you can actually watch the recordings. So here we go. Allows you to trade smaller time frames. In this case, this is 30 minutes. So we're not looking at a daily chart. We're looking at this as every bar is 30 minutes. We found that, for example, here there was a level of buyers that came in. We saw a demand and supply shift in the market, and then the market came back there. We made money from that bounce. We were able to sell off this as well. So we can make money on the market going up or down. However, don't worry if you don't understand this. This takes time. It takes, it takes time to learn this. Again, all of this is available. We offer it free. So whenever you want, just start working through the courses. But I would say first start on investing. Prove to yourself you can invest. Don't be in a rush to start this. So just a couple of testimonials to end it off. This is Ulf. We helped him make around anywhere between 3 to 7% on a monthly basis. He's been with us for over, I don't even know anymore. I've known Ulf for such a long time. But he started off learning how to trade stock market. So the same place you guys are. He started off doing exactly the same thing. We taught him how to invest. And then he also now trades the Forex market as well. This is Lewis, again, around 3 to 7. He actually did things a lot quicker. He again started out to the stock market, but that's the same as Ulf. But he moved on to Forex very, very, very quickly. But it depends on you. If you've got the time, then fine.
What is the difference in Forex and stuff?
The strategy we use behind them. And they have different certain criterias in Forex. Forex is open throughout the days, 24 hours, 5 days a week. Stocks have close time, start time. Stocks will have earnings. Forex will have certain job numbers coming out which will affect the Forex markets greatly. So different flags, different red flags, different criteria behind both. But all of this is available on your Become a Trader portal. So you can learn about Forex, but I would highly recommend you start with stocks first. Okay, that's it from me. Thank you all. My pleasure, my pleasure. I'll pass it over to Avi.
We're okay for at least another half an hour, right, guys, before you need another refreshment break? I'm okay with it. More want a break? Okay for now? So what we'll do is, does it go to the front or the back?
Yeah.
So the first of it, we're going to go through the theory, finally putting into practice a little bit of the charts you've seen and putting a 5-step process on how to actually look for opportunities, get into the opportunities, manage the opportunities, and then what to do with the funds coming out of that. We'll then have a shorter break where we'll jump onto the laptops, and what the task I'm going to give to you guys is to actually analyze and look for those opportunities yourselves using those 5 steps. We also have a cheat sheet for you too as well to take home. So you have the whole strategy in a short, concise, double-sided one-pager. So you'll be able to get a real sense of what you're doing with these opportunities. So that's the main aim and goal. There are a lot of bits that Rishi may have covered, so we can go a little bit quicker from those points. But of course, if there's questions when it comes to the strategy elements, feel free to let me know, and I'm more than happy to go over those points with you. So what we call, funnily enough, this was before the whole AI revolution, but what we call the strategy is an average index strategy. We essentially are averaging into the market. So we're choosing a stock like Rishi showed you, some of those example stocks, Tesla, Nvidia, Microsoft, Burberry, BlackBerry, not Burberry, but Burberry can also be done. And essentially we are averaging into it. So where he talked about the allocation of assets, where we are maybe reserving £2,000 for that stock, it's a case of allocating smaller amounts of money in. And we'll come on to exactly why that is. So the strategy is focused on fundamentally healthy stocks. So adding on to exactly what Rishi was speaking about earlier, the big blue chip stocks. The main reason for that, guys, is that they're so big that a small issue, or sometimes what you think is a bigger issue, is not going to rock the boat that much. Do you remember that time accidentally Samsung made exploding phones? Unintentionally, but you couldn't go into an aeroplane with them. A lot of R&D, a lot of money put into this, and you're expecting Samsung to have been affected hugely with this. What happened? The stock price acted like nothing had happened, actually rose over the next week or two, because they're a huge multinational company which has a range of products, and it's the Galaxy phone at that time, not a huge impact on the market. So this is why we want to choose the much bigger blue chip companies that have a presence across the entire globe. Trading time. So why I say 10 minutes a day and why that's put there is to build and formulate some type of routine. You'll find that this hurdle that you're crossing right now, which is the knowledge you're trying to absorb, the steps of the strategy, the looking for opportunities that we're going to do today during the class, is going to be the biggest hurdle you go through. If you spend the 10 minutes a day, this will be the biggest hurdle, because everything after that is just going to be in a slight additional, right, let me take a quick look at these stocks. Nothing has happened at all today. Great, let me move on with the rest of my day. And the main reason I can say that is, essentially, that's what I spend on this. I'm a full-time trader and investor, but in reality, if you're looking at my bum on a seat in front of the screen, the maximum I spend on a daily basis is 1 hour. The rest of that I'm spending, if I've got to be honest, procrastination is something that I always struggle with, and therefore most of it is spent doing slightly more mundane tasks. That's why I know what works well for me. My morning, the first 6-7 hours of the day, is where I really accomplish most of my goals, running of the businesses, property investments, and the rest of that is spent enjoying life. I'm one of those people who thinks we're not meant to be on this earth to work and to spend 9 to 5, 40, 50, 60 hours on accomplishing essentially enough money to be able to pay the mortgage off that you're not spending in the house. I'm one of those ones who'd love to maybe utilize more of my time. And that's exactly why I've spent the most amount of time of my life in trading and investing. I've been doing it actually, the slide's a bit outdated, about 18 years now. Started when I was 18. I'm now 36 years old. So I've been doing it for a very, very long time because it's allowed me to live the life that I want. And that's the main reason that I still want to excel in this and so passionate about teaching other people to do it because of the life that it's given me. And the biggest thing is opportunity. Go on.
Sorry to disturb you. When you describe what you're doing, property investments, and the fact that you like to spend time now focusing on investments, did you have the capital when you started?
Great question.
To do that, or did you build it up from nothing?
So the capital I had was 5,000.
You started your career with $5 grand?
Yes.
Okay.
The lucky point from that is that it was from, I like to call it stolen, but stolen money from birthdays leading up to my 18th birthday from my mum, who put it into a savings account for me, and that was my initial starting sum. Now, the great thing from that is where Rishi spoke about the mindset psychology, the fear, the greed, that plagued me my entire first year. I started in the height of the financial crisis, so that means extreme amounts of volatility, and in reality, extreme amounts of fantastic opportunity. So that first year, things went extremely well. I made great money, enough to think about, okay, 19th birthday is coming up. Let me reward myself and maybe get myself a car or whatever I wanted. And of course, I ignored all the other aspects of this. I thought, great, money is easy to be made. Everyone should be doing this. Why aren't they doing this? Until I was dealt that day where a loss came along. And because I've not actually received a loss of any substantial amount throughout that entire year, I had no proper risk management involved, no concept of what happens, what I should do if this happens. And therefore, I wiped out about 80% of my account, which worked out to be £60,000 in a day. So all that I'd done in an entire year was wiped out. And then it was a struggle to get back from that point onwards. But the initial sum was £5,000. I did have the ability and the support of my parents to not go for a traditional job in the city, which is what I was generally striving from high school to uni, to think that's what I've got to do. The support of them allowing me to do what I wanted to do with this. But beyond that, the 5,000 is where I started. And the main reason we generally look at the compounding aspect is to not have a limiting factor of belief in terms of what sometimes the outlandish numbers that we can see in the compounding charts. It's very believable if the time you're looking at it is put to work. And that's the key thing here. So the 10 minutes really reflects upon the amount of time you're going to be spending in the routine. We're just going to be looking at charts, so nothing extra in terms of additional factors on the chart. And we're going to be looking at healthy fundamental stocks, ETFs, commodities, oil, gold, silver, etc., sectors in industry. So Rishi talked about a lot of the tech industry at the moment. And we're going to look at daily charts, so exactly what we're stuck at the moment. So the main reason that we stick on the US market, for the entire existence of the stock market, the overall market has had one goal, and that's to keep creating new all-time highs. Not apparent here in the UK, which we saw on the FTSE 100. So armed with this fact, we're looking at how we can take advantage of the longer-term movements that the stock market historically makes. And the distinction that we want to make here when it comes to investing is we're spending time in the market. Most people, when they come from a beginner approach, they're trying to time the perfect time to buy the stock, get out of the stock. The most important part and the distinction we want to make when it comes to investing is that you're spending time within the market. It doesn't matter to me where I get into the stock. And that's something I learned very early on. So even 18 years into my journey, I still don't mind if there's a slight delay in me getting in. I don't get frustrated about this because I know the most important part is being involved in investing into that stock, into that time, into that moment. So the strategy basics. We're looking at an index here, the S&P 500. So these are the 500 largest stocks in the US. An indication of how they're doing, extremely well. And this is over the course of 1988 all the way through to now over the last couple of years. The basics of this is that we want to choose to be able to invest into something that's growing like this, but not have beginner traits in our approach. Very common beginner trait is to see something that's moving significantly higher. It's finally got the accolade, the attention, the media attention that you want, and you get in right at the top. Oop, that didn't work. Right at the top. Who can think of something similar right now? Cryptocurrencies. When Bitcoin is rallying higher, 60,000 plus, this is where it attracts most amount of attention and most amount of retail public think, great, this is the time that I'm going to start buying. And that's fantastic. Not if you've done it, but fantastic if most people think that way, because we're going to take a slightly contrarian approach to this. So how do we avoid retail trader mistakes? Making sure we don't give into the fear of missing out, FOMO. How many people have a fear of missing out, whether it's on social aspects, investment? The key thing with investing is that you will feel a lot of FOMO. Why? Because hindsight is prevalent in front of you. And you know what has happened in the past. You think, oh, I should have done this. Now I can see exactly what would have happened. Whereas it's a bit different in day-to-day lives to be able to quantify that at times. But in the market, FOMO is going to be a significant part of the emotion that you'll face. The key thing on this, and where we will maybe fan the FOMO fan for you, is to push you into taking some action. So what I love to do at the end of the day, we're going to try and find a couple of stocks that essentially are ready for us to invest from tomorrow when the market opens up. And what I will do is make a note of exactly that date, and I'll check in with you guys a month, 2 months down the line. What have you done with this stock? Because, hey guys, this has gone up 15%. We should have been making money here. We've made money. Half of the class has made money. How are you guys doing? That's the only point that we will use a slight bit of reverse psychology on you, but we're not evil people, believe me. So there are an abundance of safe opportunities. Doesn't have to be a case of if one has, we feel like we've missed the boat. Don't worry. There are going to be many opportunities coming through, and we'll stick to always looking for a new opportunity. And we want to have a complete system in place. So without a plan to follow, you'll most likely make costly mistakes. So it's that age-old saying of if you fail to plan, you're planning to fail. And not relying on other people's analysis and ideas. So essentially, a question you asked earlier in terms of, do we want to give in to listening to the word on the street right now? What are the articles saying right now? What is Bloomberg saying right now? A lot of that is about selling some time, some views to that article, that YouTube video, whatever it might be. The most important indication that we have is, what does the money think? Essentially, what does the chart think? And that's what we'll always base our decisions upon. So news and opinions will always be thrown at you. Rely on your own due diligence and utilize us as a resource in terms of getting a question answered. And making sure we, sorry, go on.
Big question I think a lot of us have on our mind. What is your view on cryptocurrencies? Is it a waste of time? Is it a scam? Is it something you would look at in terms of applying the trading methodology you use to experiment with stocks? What's your view on that?
So cryptocurrencies is a very interesting sentiment in terms of back in 2010, which is the first me and Rishi were told, you guys should invest into this. We stayed clear. There was hacks going on which sent prices tumbling lower. And the first time myself and Rishi finally thought, well, look, this is going to be doing something. We're going to commit a small amount of capital to this, and this is our strategy we're putting in place. We bought it the first time around the $1,000 to $1,500 mark on Bitcoin with an exit strategy of, great, as soon as we make 100%, I'm pulling my initial capital out. The next 100%, pulling that capital out, and then I'll see where it goes. We did that extremely well, went to 20,000, which is generally where we pulled a lot of that capital out, and we transformed that into a mining farm instead. So we then used that capital that we made to buy the equipment that we required for mining cryptocurrencies instead. So that meant no more new capital going into the market and purely just generating passive income. Passive income is, again, you guys know, I like to say lazy in the kindest terms. It means that I'll find the best way of me doing the task in the most efficient way of times. So I always strive for that passive income if I can. So that's in a nutshell what we've done, which is invested in NFTs. I have some land in a virtual place, which sounds very strange, but that's what the crypto world is about. Now, here comes a little bit of that skepticism in me, which is, so JP Morgan comes out and says, no traders that work for us can have any cryptocurrency holdings. You could be fired, etc., and so on. Within a week, huge positions bought by who else? JP Morgan. So you're thinking, okay, that's quite interesting because there's a limited supply, which the whole reason that cryptocurrency is meant to be very interesting is that there's a limited supply of those coins in the same way that we have gold, a limited supply of gold on this earth. And therefore, the lower the supply of that, the higher the price should be. However, there can be some aspects of manipulation in this in terms of they understand how a retail mind thinks, which I said here, making sure that we don't get in at the end of a bull run. Retail traders will love to get in right at the top. They understand what they should be doing, how to manipulate these aspects. And so can you invest with our strategy on cryptocurrency safely? Yes. My opinion on this space is a bit of an interesting one because I think, again, it was meant to be a bit of a level playing field, but I feel as though the 1%ers are going to be running away with the money, with the way that they will be able to control it. And so it's a very interesting sentiment on it.
And does everyone understand what mining means, crypto mining? Because I think it's really important just to ask that question. Do you want to explain it?
Yeah. So in a nutshell, what crypto mining is there is going to be 21 million, just in the likes of Bitcoin, 21 million coins in existence. So let's think about it as 21 million gold coins or 1 ounce coins that are going to be in existence. And essentially why it's called mining is that we're digging these coins out of the earth. More so over a system of networks between the globe. So we are using computing power or graphics power to essentially solve algorithms to be able to mine these coins. And as a reward for essentially lending out our computing power, you're paid a reward on this. So for example, in our heyday of making, the amount we're making, probably about $10,000 a day by mining. But more recently with the complexities increasing as well as energy costs increasing, it's probably a tenth of that. So it's a space which, can you enter right now? No. Again, a bit on the fence in regards to why not, because the best equipment is given to those that can afford it the most, and that is then only given to the secondary market once that is a bit more on the older side. So it does have a bit of the drawdowns now when it comes to mining, but that's in a nutshell what mining is. And there is going to be a very good benefit of blockchain technology and cryptocurrency down the line. Just at the moment and in this space right now, it's something that if you haven't got into right now, the only approach you would take would be using the strategy that we're going to go through right now. And that would keep you safe.
I just want to ask everyone to ask the biggest question that's on their mind at the moment. Do they understand what's happening yet? Do they have any burning questions? Do you want to go first? Any questions so far? You're good? You're comfortable with everything? Or do you want to go? Please.
So if you can't get into cryptocurrency at this stage, I've heard about blockchain and stuff, but I'm not quite sure how you get into it as a supporting
tactic or strategy alongside your main job. Is that the question?
Yes.
Okay. Does that make sense? Should I repeat that?
So right now, we'll take a look at the chart, but right now we can look, when we go for the task of actually looking for stock opportunities, we'll look at Bitcoin as well, because there has been a bit of a tumble more recently, so there could be an aspect of us potentially having an investment opportunity in this. And again, it's an aspect of planning. So this strategy will allow you to have a 5-step process of being able to plan towards it. Essentially, that means that when you start to take the jump and the leap of faith into investing into the cryptocurrency markets, you're going to be kept safe. In terms of you know what your exit strategy is, how much money you're going to be making and calling it a day and waiting for another opportunity. At the same time, if it continues to fall, you know what you're going to be doing in that space as well. So after today, you'll definitely know what to do within the crypto space as well as in the stock market and commodities, etc.
Jenny, any questions?
So is there a minimum amount for your strategy with the 10 shares that you would
Great question. You have full access to a calculator that will basically allow you to plan what you're doing with whatever money you want to invest into. And the main reason that we also utilize ActivTrades for yourselves is that with the partial shares, you can invest with as little as £10, £100, even if that one share price is $1,000. Doesn't matter. That's why we've chosen this broker, because the barriers to entry are lower. Whereas in the US, nope, you've got to have $1,000 to be able to get into it. So really it's applicable to wherever your investment starting point is. Good.
One question. What do you think the future use case of blockchain is going to be? Because I've always wondered to myself, what sort of use cases are going to have in the future?
I think the real benefit on why I really bought into the idea of NFTs, which is, let's say, an artwork, or whether it's a piece of land that I do have or something like this, is that when it comes to the ownership of something, it's undeniable. So within the blockchain technology, there's resources to essentially check that you are the true owner of something that you say you are. Whereas, let's say, for example, in art in the past, where you could have a Monet or whatever it might be, which can have a replica. That replica might be passed as the real one, and you need to get an expert to come through and verify, etc., and so on, what it is going to be, or which one is the right one, which one's the wrong one. Whereas with an aspect of blockchain, that's one of the many benefits of being able to see the sole owner of this, amongst a lot of others. I did have a lot more of the benefits of it in terms of the wealth, in terms of Bitcoin and so on, but I think it's taken a bit of a turn to the dark side, and I think Rishi will have a few more comments on that side of things.
Just to even add on where I believe blockchain will be implemented more and more in. If you think about what blockchain technology is, it's a ledger, right? So being able to see clearly these transactions. So I think this is going to be very, very useful in the accounting world. I know from a few friends that they've already had accountant friends of mine which have already started to learn more about the blockchain technology and how that's going to be applicable within accounting. You know, for example, IBM had all their employees learn about blockchain technology, because the fact that you can now cross-reference ledgers and it be absolute, there's no discrepancy between them, is going to have a huge use case in terms of blockchain technology, maybe not in terms of cryptocurrency, but the technology itself. So I personally really enjoy getting into infrastructure plays. So that's things like investing in companies which are making it possible to do this. Going back to NVIDIA is one of those, because they make the technology for this to be possible. And we know that there's a global chip shortage, so that just adds to the demand and reduces the supply, and then you see that price go up. So there's a lot of plays you can make around the infrastructure of blockchain without even getting into cryptocurrencies.
We have a couple of questions coming through on the live stream, if I can raise them. Question number one from Jonathan Barron is it safer to just keep your money in the bank?
No. The main reason for that is, even though Rishi talked about inflation going back to that 2% level, how many of you have found that your weekly bills have returned back to where they were a year ago? Far from it. And that's the real rate of inflation, is generally on the higher aspect of things. So if you were to leave money just in the bank and not get the right type of returns in terms of interest, essentially you're losing money on a yearly basis. That's why, in general, what high net worth individuals, those with millions plus, are looking for is a bare minimum of 7% a year in terms of their return. So you can see how looking for us as being 20 to 30% is still looking to outperform that aspect. But that 7% a year will allow them to really beat the real rate of inflation. And if it's just put in the bank, not so great. The other advantage of ActivTrades with the additional insurance that they can provide you is that essentially it's safer than putting your money in the bank. As with the bank, you're secure for $85,000, I think, under the FCSC. Yeah.
Another question, is a very direct question from Nikita in New York, who's live streamed in. Do you have any factual proof of actual profits that have been obtained from students or yourself from these trading strategies and their brokerage accounts?
It's a
quite a
Do
direct
we
question.
have actual breakdown accounts from themselves? Other than their actual testimonials, do we have screenshots?
Remember we took the screenshots of like loads of accounts. We didn't link them up.
So I guess we could put a PDF up onto the website or something like that. Yes, we try not to tiptoe in the aspects of diving into too much of people's personal finances because a lot of people don't like to generally share. But we have endless amounts of testimony. So the two that you've seen here, we probably have about a 20-minute video of people talking about their own experiences of this as well, and that's something we could put together.
And you also asked what's your own performance been from your own trading career?
So the reason that we say that 20 to 30% is that me and Rishi achieve that 20 to 30% when it comes to our investing. All of the strategies that we teach are the ones that we implement ourselves, whether it's investing or the trading. The performance that we talk about, so on the trading, 2 to 4% is exactly what me and Rishi achieve for. And that doesn't mean that our students don't make more than us. That's our lifestyle to return balance. So there's been times that the best year I've had, not the best number actually, but within 16-month period, I'm going to round it up to 667 because the real number was 666. But that was the percentage return that I had when I first started trading in the markets, because I dedicated all my time into it. And then it was about finding the right type of balance for myself between what I wanted to do in life as I grow older, socialize more, get married, do other business ventures, and the charitable aspects as well.
Bless you.
Any other questions?
No, that's everything live.
Brilliant. So, guys, with those questions, please do feel free at any point if you do have those ones. More than happy. But also, I know there will be a lot of questions after this as well. So at the end, we will be going through your next steps in terms of how to utilize the support, where to send your questions in, etc. Right. So let's take a look at a basic approach of what we want to do in the markets. So this is the nutshell of the strategy, and then we'll go to the 5 steps. So how do we approach the market? Here we have Tesla in the past at some point where we'd seen a significant rally. What do we not want to do at the end of a bull run? We never want to make a retail mistake of buying at the top. We want discounted prices. So remember I talked about a contrarian approach. Essentially, we want to be buying Tesla when it's falling. How much? By 20%. So essentially, we are waiting for a sale in the market. We already know Tesla is a fundamentally sound stock, one that's been trending nicely to the upside. We're looking for some type of overall market turmoil or something, let's say, slightly negative in the likes of Tesla for the time being to attract us to start investing, and that's going to be at a 20% drop. So we wait for a 20% fall, but we do also have a plan of action because we can't expect it to fall by 20% and then rally upwards. We've got to really account for any eventuality, which means that if it were to fall by 30%, 40% or beyond, we need to know what to do every single step of the way, and that's what we do. So for this example, we fell by as much as 20%, and that essentially will be our first entry point. So on that risk management aspect, where if we were looking to allocate £2,000 to Tesla, one common retail mistake, buying right at the top. Second common retail mistake, putting all £2,000 into Tesla. We're splitting our capital into various sums. We'll come onto the calculator, and this will work out exactly based upon what number you give it, the split that you will have.
Do you always wait till there's a drop, or do you ever get ahead of the curve? Like,
no, always wait for the drop.
so you couldn't have gone to March?
Well, hindsight's beautiful, but we're not going to get that price point anymore at $100. We're only getting the current price point, and that's it.
Do you ever look at an item, fine, here you're looking at the market, and you're making a decision based on the market.
Yeah.
Do you ever look at an item irrespective of the market and think, wow, this is great, this is going to go somewhere? And you get in
cars.
Really.
That's the only point that I would think in terms of an aspect other than the market that I like to invest, because I personally think that this will happen, is with cars. So I generally wouldn't buy a brand new car, much prefer to buy something that I think is going to be turning into more of a classic car with the right type of potential for uplift. So for example, a car that I have on average goes up by maybe £5,000 to £7,000 a year, and I can still use it. So Does that answer that question? Did you mean that type of investment, or you mean anything outside of stocks? Or
something that is going to be sold on the market, you think, wow, what a great product. Let's say the mobile phone had never,
Okay.
never existed before, and suddenly the mobile phone comes on and you're like, wow, this is amazing. So there's no past performance to look at, there's no trends.
Yeah, great question.
And then you think, wow, all right, I'm going to get in on this. So it's based on your subjectivity,
Yep.
not...
In a nutshell, no. We'll come on to exactly why that is when we look at where we invest, because that's essentially a startup or an IPO, the initial price that is put into the market. I'm happy to wait to see what happens to that, and if it does fall by 20%, happy to pull the trigger at that point. But I like to have data to show and reaffirm and build that confidence into that investment. So at any point in time, I'm happily sleeping. I don't need to worry about looking at these investments. And I've had that in my time. Both myself and Rishi, we traded I think it was a 20 million pound fund. And when we first started on that, for 2 to 3 months, I struggled to sleep because I always wanted to look. Because unfortunately, I knew the investors. And therefore, that meant that I cared a little bit too much. If I was doing that trade on my own account, I could sleep like a baby. Because it's not my own account, I wasn't able to until I got the coaching required to be able to do that. So there's always multiple things that will kind of come into the realms of why I do things and why I don't. And most importantly, I want to be rest assured with all my investments. Knowing that, sure, you can't account for all eventualities, but I've done my best to keep me out of any of the stress elements. I think the more stressed you are, the less lifeline you generally have. So after a 20% drop, the first entry we would have would be at that point. And let's say that 2,000 split into 8 times going to be £250. Essentially, we're buying £250 worth of Tesla stock after a 20% fall. Now, in this instance, Tesla continued to drop lower. It fell down by another 10%, down to 30%. And that would trigger our second entry into this. Once again, all pre-planned. We know when it gets to that point, we're going to be investing another, in this example, keeping it simple, another £250. So now, in total, we've invested £500 into Tesla, but we've not invested at just the one price, but at 2 prices. And in this instance, so what that does is that it would bring an average price between the two. Essentially, a line which, if you do cross beyond, you're in profit. One might be slightly in a loss scenario, but you're making more on the second investment, and you're in a positive overall position. That's the key part here, and why we call it averaging into the market, or the AI strategy. Now, to add an extra step onto that, every time that the market falls, so we're getting in a further and further time, we're actually going to be adding more capital to this. So exactly that. So if we had, say, invested 250 at a 20% drop, if it came to 30%, we'd be investing, let's say, 275 to 300 pounds. Why? Because we're able to buy more stock at a cheaper price, but also by doing so, essentially value cost averaging, we're drawing that average price lower and lower. So remember, importantly, Rishi said that it doesn't have to be a stock that is affluent and you know that it's going to be bouncing back and making new all-time highs. You only need to care that it's making some type of fight back. Because the lower that we have that average price, the smaller the push to the upside will be required for us to reach our target profit. And in this instance, we're looking for a minimum of 15 to 20% profit. So if the green line represented our average price after getting in 2 times, in this instance, it took a couple of weeks, but it got to that point. And you can see nowhere near that previous high. But at that point there, we would have achieved 20% profit. So that's our money that we invested into Tesla has increased by 20%. We bank that profit and we look for the next opportunity. Simplistic in its approach, we're going to break that down into 5 steps. And on top of that, Rishi, if you could pass the cheat sheets out as well so people can also refer back to this. We were aiming to be done by 10 o'clock. We might be going a little bit beyond that point. Is there any times? That's not a problem, as everything will be recorded as well. Yeah. So step 1, where do we invest? Richie touched upon a lot of these elements in regards to where we're going to be investing. But essentially, when it comes to the risk spectrum, we added cryptocurrencies into this as well. And you'll see that holding in cash, no risk, but you're not looking at any type of return. And we touched upon how, in reality, with cash, you're actually losing money if you're keeping it in the bank. We then have slightly safer investments, but not really giving us as much return. So bonds, high yield, hybrid securities, property, especially with interest rates right now, not exactly the most lucrative place to be parking money in, unless you're very cash rich. Developed market stocks, emerging market stocks, and then cryptocurrencies. So we want to find the right balance, and of course, developed market stocks, having that data is the key element and the most important part for us. So when we look at the investment spectrum, and just answering that question that came on earlier, an ICO, which is the first time that a cryptocurrency is going to be coming out, or even large market ICOs, are going to be way more riskier investments because it's a slightly more of an unknown. Stock markets have been around since the 1600s, so they're likely to outlast ourselves as well. We then have IPOs, the very first time a stock is offered. Again, very much more risky. Penny stocks, those who looked at it in the UK. And then we have fundamentally healthy stocks, commodities, sectors, and indexes. And our sweet spot is going to be looking across these three elements. The safer the investment you go to, the fewer the opportunities. So that's why we want to have the right balance. If we choose the safest opportunity, we might have one opportunity, one trade every year. And of course, we want to be able to grow our account, so we want to spend a little bit more time there. So a list of fundamentally healthy stocks, blue chip stocks. I'm sure most of these are very much household names. But essentially, we are choosing these because they have the lowest probability of going to zero. And only if a stock were to fall to zero could we incur a loss. And this is the best reason to really go on to the next point, which is using this average index strategy, which I've been using for about 18 years now. I've had one loss and one loss only. And that was on a UK company called Carillion, which unfortunately went to administration. Overall, I lost only 2%. So even the most stringent of risk, and I remember Daniel's partner, I think, said 3% of a risk, it fell within the category of that. So the most important part here is to choose an investment you believe has the lowest ability of going to zero. And that means the likes of Amazon, Pfizer, Citigroup, Nestle, Pepsi, Johnson & Johnson, IBM, 3M, Intel. These are all a host of stocks. Maybe Boeing we're sitting a little bit more on the fence of right now. Even so, you probably using this strategy will be able to make money, and we have. But there has to be slightly more of a smarter play that you do based upon what you see in the market. Commodities, so the likes of agricultural commodities will have slightly more of a higher risk when it comes to, let's say, wheat, corn, frozen orange juice, whatever it might be in regards to what happens with the weather. But when it looks at the likes of gold, silver, copper, palladium, platinum, all of these elements that are used in day-to-day life, these are the type of safe investments that we're looking for. But again, a lot more safer than, let's say, stocks are, and therefore the opportunities will be a little bit less in the number of opportunities that will come across for us. And then there are sectors. So Rishi touched upon, we might want to choose a tracker that just tracks the tech sector, because you've seen AI is thriving right now, and a lot of capital is being pumped into it. We're not even scratched the surface yet in terms of use of it. How many of you actually use AI on your day-to-day lives right now? One out of all of us. Well, me included, two of us. So you can see there's still a lot more use that will come into it as time progresses. And therefore, that space is still going to grow. So we can invest in a particular sector, and that will be even safer, because what would require a loss there is for all of the tech stocks to go to zero, essentially. So what we want to avoid, penny stocks, IPOs, and trackers that we don't understand. Slightly more developed aspect is when it comes to trackers, we don't want to choose inverse trackers or leverage trackers. Essentially increasing our risk, and an inverse tracker is following in the opposite way. So again, added risks. So we know essentially where we want to invest. Step 2 is finding our entry price. We touched upon it a little bit by that 20% drop. So a practical run through is what we're going to go through, and we're going to try and hit all of these elements. So we're going to be choosing a safe asset, finding the most recent peak over the last 12 months. We're going to then measure for, and if it hasn't come yet, we can streamline our lives a little bit and place an alert. So this is what I mean. This aspect here is going to be the biggest hurdle. See when an alert happens. Because if you look at the stock already and you've analyzed it, you know where it needs to come to before you take some action. And I'm going to show you how that has really portrayed. Now, if it has fallen by 20% and we can still enter into the market, this is going to be one that we note down for potential action from tomorrow onwards when the market opens. So let's go through this process now. Thank you. Okay, so there's a few things that will make life a lot easier when it comes to looking at some charts. We're going to look at some practical examples very soon on your own computers. But we want to look at a 12-month view to be able to gauge where the highest point the market has been. So this here is exactly 12 months view. Who could tell me where the highest point that we see in this chart? So this is Nike that we're looking at. Where's the highest point that the chart has been? Not a trick question. This point here. Looks like the stock price has, all of these bars have not come any higher than this point here. So I'm going to make a note of that with just a square so we can remember. Oops, that's not the best square. There we go. So somewhere in there is the highest point that the market has been over a 12-month period. We can also not need to have to use a calculator. We can use charting software to make life a little easier. There's a measuring tool that we can utilize here that will allow us to draw right from the top. And if we start to drag this down, there's a number in the middle here which represents how much of a fall this has taken from the top to the bottom. This might be a little bit small on the back, but you might have to trust me to say that it's 23%. So the current stock price that we have right now on Nike is all the way down here at $75. So if we drag this tool all the way down to that point, and I just set it there, we actually have a 38.69% drop on Nike. Now, what was the initial criteria? Something safe. Do you think Nike can go to zero? And this is the most important thing. If you think it can, you stay away, you look for the next opportunity. Most of you nodded that no, you don't think so, which is also where I sit. And therefore, if we've seen a almost 39% fall in the likes of Nike, has it fallen more than 20%? Yes. Is it still at that point? Yes, it's fallen way more than 20%. It's still below 20%. So essentially, we have our very first opportunity in the likes of Nike. So I'll make a note of that, and we can address a little bit that when we come to the practical element. But Nike, the very first one we looked at here from Rishi's list, is perfect for an opportunity right now. I'm going to look at is there any suggestion of any stock you'd like to take a look at? Any, what you think is a big blue chip stock, and we can look at it? Netflix, let's take a look at Netflix. So Netflix over the past 1 year, where is the highest point that Netflix has been over the past year? Yep, about last Friday. So last Friday, it hit a new high over the last 12 months. So new opportunity, Netflix, we're looking at it. Highest point, exactly where it is. What can we do? Absolutely nothing, but wait patiently. Now, in regards to, let's say, being efficient and being slightly smarter in terms of use of your time, what we can do is actually allow the charting software to work harder for ourselves. So we could say, great, this is the highest point you've been. I want you to tell me when you drop 20% from here. So what I can do is, once again, using the measuring tool, I can highlight a 20% fall. which will be, oh, not too far away, but so around here. If Netflix were to fall to around $560, that would be a 20% fall in price. And so what we can do is we can right-click on the chart and we can set an alert. So what that would allow us to do is pre-program with the charting software that when it comes to this price point, I want you to tell me that, what do you want me to tell me? I can write a message. So I can say, has fallen by 20%. So if it comes one day later, 1 month later, or even longer, you're reminded of exactly why you're being alerted, and that's all. So you can click Create Alert, and then we can move on to the next stock entirely. Question?
With them, like, because it's fallen 39%, so obviously nearly 40%. Would you then look at your kind of 3/8 of your amount you want to put in?
Fantastic question. Really good question. So just to repeat the question on this, because the previous one that we looked at, Nike, had fallen by so much, by almost 40%, so almost putting on your shoes and saying, had I been investing already, I would have got in at 20%, 30%, and 40%. Could we essentially invest into Nike using a combination of those three positions? The simple answer to that would be yes. Would I do that? Yes, absolutely. But if you're starting off and you want to keep things a little bit safer, a little bit less of an emotional roller coaster, you can just start off with the one position. But if you're feeling confident around it, absolutely. So that's where it makes absolute sense, where you're getting an even bigger sale. It's almost like going to Costco and seeing that the toilet roll is half the price and thinking, well, I might as well buy 12 months supply instead of 6. And that is because the reward will be, when it does go up, it's a lot easier to be able to achieve your 15-20% target. Any other stocks you'd like to take a look at? I would, let's say, we can look at Tesla to see where it is, because you spoke about it so much. And what you will see is a stock that over the course of the last year has been trending downwards. But what I want you to do is follow along what has actually happened during these drops. So where we did have the highest point, at that point, we fell by as much as 30% from that point. So back here in August of 2023, we would have been investing into this, which, had we invested into this, you would have seen so had it fallen by 20% here, how much of a rally did we have? We had about a 27% high. So we would have got in and out with profit. What we can then do with this is use this as a new reference point for a lower peak. And once again, we fell by as much as 30%. Clearly, what we could see beyond that, we had more than a 20% rally. What did we have after that? Another 20% drop, which continued. And then we had a rally. So over the course of the last year on Tesla, we actually had 1, 2, 3 profitable trades. And the frustrating thing that we had over the course of the last couple of weeks or so is we were waiting for an opportunity to drop by 20%. So you can see by being proactive, this dotted line represented where we wanted to see Tesla drop down to so that we can start to buy again. But unfortunately, it had different ideas. And since then, it's been rallying significantly higher. So a lot of this has left really for us right now. And that's not a negative. That just means that we have to be waiting patiently once again for the likes of Tesla. One other stock I do want to show you is Disney. So over the course of the last year, Disney, highest point that we've seen, clearly is up here, which is around April, May of this year. And since then, what we can see is a fall of 21%. So just gone beyond that threshold of that 20%, and that's why just this last Thursday, Friday, we got into Disney for the very first time. Is it still at 21% or below? Yes. So it means, again, in addition to Nike, Disney is a great opportunity for us to get into from tomorrow. Yeah. Question?
You know when you say take your profit plus 15% from your average investment, when you say take profit, do you mean take all your money out or just your
Yes.
profit?
All your money out. Yep. So essentially, had we invested, let's say, £500 into Tesla, and we made 15%, so like £70 on top, £75, we then close that trade out. So 575 will be banked, and then we can move on to investing elsewhere. Make sense? Right. Any questions on this step? We're then going to progress on to the next step on the slides, and then we'll go on to some practice for yourselves.
What happens if it never makes 15% profit? You just wait and wait and wait until it makes it.
Unfortunately, yes. Now, the averages, so at the moment it's between the 2 to 3 month mark that you'll see you get into a trade and you come out. But during COVID, that could be around the 2 to 3 week mark. On average, longer term, it's been more the 3 to 4 month mark. So right now we're sitting between 2 and 3 months that you generally get in and come out with your profit. But it's also one of the reasons that we still stick with the US markets. Because when it comes to UK market, you'll be waiting a lot longer for that investment to finally pay some dividend. Okay, step 3, splitting our capital and determining risks. Rishi touched upon this initially. And what we're going to look at here is, and he touched upon using, if we have a 20,000 pot, 10% is going to be utilized on any individual stock. So that means even if everything goes terribly wrong for that particular stock and Tesla eventually does actually go to zero, the absolute worst case scenario that you have is losing 10% of your investment portfolio, which if you're thinking over the last 18 years that it's only happened to me once, and that was 2% loss, it's something that I'm willing to risk. In actual effect, I should be willing to risk a lot more than this, but still I like to keep risk averse. So we keep our capital split, and what I want to show you is the number of entries. So when it comes to adjusting the number of entries, so any investor's journey will be different in regards to how much confidence they may have, but also in terms of maybe a limiting factor of how much capital they have. So you might not have a £20,000 pot to split across the multiple stocks, you might have less, and therefore what we can do is utilize a different number of entries. So where we originally spoke about splitting the £2,000 into 8 different pots, if you have less capital, you can choose to use maybe 5 different entries. So that means that you can look for a 20, 30, 40, 50, 60% drop in the market, have the capital to be able to apply into the market there. Because it's very rare for a stock to fall by 80, 90%. So, for example, if you're looking at a portfolio across 4 different assets, so Facebook or Meta, Amazon, Tesla, and the likes of gold as a commodity. And let's say the maximum that we want to invest based upon the fact that we have maybe 100,000 in the entire investment portfolio, we're going to allocate a maximum of 10,000 for each asset. Doesn't mean that we will get those 10,000 invested. So for example, we could have maybe 3 entries on Facebook, only 2 on Amazon, 4 on Tesla, and only 1 on gold. The amount invested would be very different. So it could be 3,000 in Facebook, 2,000 Amazon, 5,000 into Tesla, and only the 1,000 into gold. So you can see, even though you might have a £100,000 account, you're going to be very liquid in your investments, which means that you have full control of when and if you need to utilize that money elsewhere in life as well. Now, of course, that will affect the compounding curve, but you can see the full investment here is only £11,000 of the entire 100,000. So you're not going to be fully allocated, which means that you can always take advantage of any opportunities that come. You'll have enough capital to do so, if you follow this well. So when it comes to what we refer to as feathering into positions, it's important to split up capital to invest into assets. You never have to have the pressure of determining the best available price. So we know exactly when we're going to get into before we even decide to pull the trigger. So we essentially want to come away from what I found my granddad was doing, which is essentially buying, holding in UK shares because you're told that that's a great idea to do. Where in reality, with people who are doing buy and hold, it's more of an aspect of what we can refer to as buy and hope. You're hoping that the point that you got into the market for whatever reason you did is the right time and eventually it will go up. Just by applying a few principles onto this, we can make sure that we are staying ahead of the curve. So what I mean by feathering in, if we're looking at, let's say, that Tesla stock as well, where it's fallen by 20%, and let's say our first investment was going to be £500, at a 30% drop, it might not fall to this point, but at a 30% drop, we know that we're going to be increasing this amount by a further 20%. So we know that we're going to be increasing to a pot of £600 if the share price gets there. And if it goes any lower, increasing it by a further 20%. The main reason we do that is to be capital heavy at the bottom because we want to acquire the most amount of shares at the lowest price. If we put in most of the money at the top, the average price will stay significantly higher. And we've talked about the calculator a lot. This essentially is going to be that calculator. So I'm going to break it up into two halves. We just need to look at essentially this bit here. We put in the stock symbol, and with it being a Google Sheets, that will pull up the live price of the stock price as well. So it allows for these numbers in the fancy bits to look nicer. Essentially though, what we do here is where we looked in the chart and we picked out the highest point, we put that number into this. So let's say for Tesla, the highest point of the last 12 months was $218. We then have the ability of changing the positions from, let's say, 8 all the way down to 2. So you could choose any number between that. And you tell the calculator the amount that you want to invest into this one particular stock. So if you're investing the full £2,000 into the stock, then you put the number £2,000 there, and it will give you a breakdown of what you should be getting in at each and every time of those intervals. So essentially, if we had a total investment of 10,000, it means the very first time we get into the stock, we should only be buying £606. And you can see, bless you, you can see it's very different to when you start getting in a fourth or fifth time, where it's double the amount. And that really allows for the average price to come significantly lower. On the left-hand side, we actually have a journal. So two elements are created here. By putting in the highest point there, it tells you exactly what price points you need to get to before you have those next entries, so 20%, 30%, 40% decline. Once you start to put in the price that you bought the shares and how many shares you've bought, you'll also see that the right-hand side start to determine your profit right now in terms of percentage, in terms of monetary value, and also where the 15% profit target or 20% target will be. So it allows you to be able to not only determine your entries and the amount that you should be investing, but also to be able to journal your process as well, so you never forget exactly what you've done. Is there any questions on that? Does that make sense?
So where is this calculator?
We'll show you on the website, but basically from our website where you'll get access to all our courses, you have to download this from the resources. So all of everything that we've gone through now, you'll actually have in a lot more in depth on the online course, as well as the resources that we spoke about with the calculator, as well as the compounding calculator as well. So you can start putting your own numbers in here. Any questions on that element? Step 4, getting into the trade. So this is where we actually start to, and we will do in a moment, look at your platforms and start to actually invest into this. So if we come to this point, it means that we found something like Nike or Disney, something that's ready for us to get into. We've used our calculator to know how much we're going to be investing, and we can get into it in two different ways. In reality, well, we spoke about stock market timings in regards to UK, which is between 2:30 to 9 p.m. Is there anyone here who can't actually access the market at any point in time between 2:30 and 9 p.m. on a Monday to Friday? You'd have a few minutes here and there? Perfect. The reason I ask is that the best way of getting into the market is going to be the way that we want you to get in. And for those who are extremely busy, there is a slight alternative which has a few the downsides, but remember, we're spending time in the market, which is the most important thing. So what we want to be doing, and we've gone through all the points of which asset we're going to get into, knowing how much money we're going to put into the market, we're going to be using what is referred to as a market order. The alternative is something using a pending order. What a market order means is we're telling the broker we want to buy this amount of shares of Disney, get into the stock right now, please. And we have to press the button to execute that. So what a market order will look like is this. This is what we refer to as an order ticket. So what you can see here, this is Apple, for example, and it's telling you if you want to do buy or sell the share. The price of one Apple share being $173. When it says lots here, this is referring to how many shares do you want to purchase. So the calculator will determine that for you already. You know what the monetary amount will be. And the only thing that you need to adjust beyond getting this ticket up is making sure that you click on the buy button, putting the amount of shares that you need to buy according to the calculator, and then placing the order. That is it. Just those 3 steps. Opening the ticket, making sure it says buy, the amount of shares, and placing the order. That will essentially execute the order, which means that the broker will purchase the shares on your behalf. Now remember, this can be as a fractional of a share. Essentially what you need to do is refer to this number here, which refers to what it says is margin, but Rishi mentioned we're not going to be using any margin, so we're not going to be borrowing any money from the broker. So with the calculator determining how much you want to invest, you put in the number of shares. This number here should match up that investment. So if it was going to be £600, we put in, let's say, 3 shares. It says £600. We know that we're correct. We place the order. Now, it's going to be very rare for you to make a bad mistake here and buy, £6,000 worth of shares, because the broker will not allow you to do so, as you don't have the money to do so, etc. So it's very rare for you to make a silly mistake on this, but of course, always check in with us and just double check, confirm that you're on the right tracks. So it can differ across different brokers what it might look like, but with the likes of ActivTrades, this is what it'll look like. And we just determine click the buy button, determine the number of lots, which refers to 1 share. And it can be fractional, so it can be 0.1, for example, as well. It's not limited to just half a share. You can buy 1/10 of a share, 1/5 of a share, etc. Any questions on that element? That's a nice simple point. And then we won't go for the pending element, as we don't need to. But if you're not able to get into the market during the hours of 2:30 and 9 p.m., which is essentially when the market is open for whatever reason, there is an alternative of a pending order, which has one extra step. That is also telling the broker what price that you want to get into the market. So they will get in at your desired price. So you still have the ability of choosing exactly what you want to do. Now, when it comes to margin, we touched upon what margin means in terms of borrowing funds from the broker. This is something that we don't want to be doing, because coming back to the average amount of time we spend in a stock between the 2 to 4 month mark, or 2 to 3 month mark, if we are borrowing money from the broker, we're going to be charged daily interest, which could be minimal, 10p, 20p, 50p, but over the course of 20 days a month, so maybe 40 to 60 days, it adds up. It adds up into eating into our profit, and that's what we don't want. So we don't need to utilize any margin there. Also a huge common retail mistake in terms of utilizing way too much margin. So it ends up meaning that you're taking way too much risk and doesn't lead to the success of your journey really trading. So nutshell, with margin, we don't want to be utilizing margin. Any questions on that? And when it comes to which to use, we're going to be using a market order over the pending order. Now, managing your positions. So we looked at a brief example of a ticket. We're going to look at your platforms in a moment. But when it comes to our target profit, we're looking at a bare minimum of 15%. So the reason being for that is, historically, once we've been through our data and we looked at the average amount that the market would go up before a further decline, that was the sweet spot. So that can change, and it can change for the better. So more recently, because the markets have been a bit more volatile, we're happy to go for a 20% target profit. generally don't want to go any less than that 15%. So there's a few options for us once we reach that target. We can either close the entire position and then use the capital elsewhere. We can either close a portion of the position if we believe there's further potential to climb. So if you remember NVIDIA, that's a great example to use on the second bullet point here, where we're seeing NVIDIA just climb higher and higher and higher over the course of a year, going up by 100, 200, 300%. That's maybe when we get an opportunity to invest here, we might only want to bank half the profit and leave the rest of the capital in for the hope that it will continue doing what it has done over the past couple of years. And so by doing option number 2, we've allowed ourselves to really build a longer term portfolio with, let's say, stocks like Apple, Microsoft, Meta, that we've had in there for 5, 6, 7, 8 years. So we've been investing, banking some profits, but allowing bigger positions to build up over a number of years. The advantage of that is that these positions will be really like the compounding calculators, but on steroids. Because the growth that the market has in the US stocks is exactly that, capitalism on steroids. The amount of capital that goes in is crazy when you compare to the UK. Right, so let's take a look at those elements. Same example on Tesla, where we fell by 20%, got in one time, fell by a further 10% to a 30% decline, and we got in a second time, reducing our average price down. As soon as it reaches our target profit of 15%, we're able to execute one of those options. So with the likes of Tesla, for example, again, could be one that you hold and accumulate some stock for later on. Yep.
What would indicate that it is going to continue rising? What kind of
So where we looked at those 3 stocks, Nike, which had been declining, not giving that indication at all. Where we look at Disney, which had been going all right, but had a decline right now, not so much. But when we looked at Netflix, for example, that's pretty much been going one direction at the moment. And so that would be a perfect example of that. So over the course of the last year, if you only see that it's only been going one direction, you have a bit of an inkling in terms of this is what I like to do. But importantly, you're not on your own. So when it comes to a point where you're indecisive of, I've reached this target profit, what should I do? Ask us the question, and we'll get back to you as soon as we can. The one key thing here is that time really doesn't have that factor. If you would ask that question, you get a response within a few hours, absolutely fine. It's not going to play the biggest role in terms of determining your success. So when it comes to securing the profit, there's one extra step that we want to do. Once we've gone beyond that 10% threshold of profit, there's one step that we're going to do, which is eliminating all the risk. So we want to basically tell the broker that we want to implement a stop loss at our entry price. What that means is, after we move up by 10%, by putting a stop loss at our entry price, we can determine that that stock can no longer make a loss for us. And there's 2 reasons behind that. Is one, I want you to start to actually reward yourselves. So when you first start doing this, once you met 10%, I want you to secure a bare minimum of 5% reward. So what that means is that the worst case scenario, if Apple were to now start coming down after making 10%, we hit the 5% threshold, the broker will automatically bank 5% profit for you. You're out of Apple, you move to the next opportunity.
So stop loss is basically you say to the broker when it gets down to this point when you sell it.
Exactly. Now in the name, it does sound as though it's stopping your losses, but it can also be used when you're in a profitable scenario as well. So it's stopping any further losses beyond this point. So where you would find that, when you have the open positions, and this is something that we can go through a little bit more with ease on the live webinars when it comes to a trade that we want to get out, but you'll see that it'll say Apple at the bottom, and you're able to click on the X, which will allow you to be able to close a position, and this is what you'll see. Either you close a position here, or allows you to be able to modify the position here. So we're able to put the stop loss in. Alternatively, if we're just closing the target profit out at the 15% mark, we're doing the exact same step. There we go. Exact same step of closing the position. But what we can do, like with the Netflix example or NVIDIA, If we bought 10 shares of Apple here, what we can do is maybe close only the 5 shares. So we're leaving half the position on to continue moving and making profit, and the other half we're banking to be able to replenish our account size so we can look for further opportunities.
Abby, when you've got a demo account, can you run a demo account as if it's a real account, but you're not actually really paying money?
Yes, you can. Once you have your accounts open and you do a demo account that way, it will be an endless demo account, so you can allow you to do for longer term. What we're going to just show you now, for those that maybe don't have their accounts fully set up, is show you how to jump on a demo account, which I think has a 3-day limit. So not great for seeing can I make success out of trading, but fantastic for utilizing the entire platform and finding opportunities, etc.
Why won't they let you have a demo account for more than 3 days?
If you don't have an account set up. If you have the account set up and you do it that way, then it's longer term.
Because I think a lot of people would love to just use a demo account to test it first.
Yeah, of course. Yep.
Build the confidence and then move into trading.
Yep.
Do you need to pay to get a demo?
There's no payment required to us, ActivTraders, the broker, anything like this at all, no. And of course, there are many tools that, let's say, that people think that they might need, etc. But in reality, we don't want to be having any cost for you at the start. Once you're then a seasoned investor or trader, you can start to maybe utilize other tools that might just make your life easier, but why not pay for that with the profits rather than right at the start and eating to capital instead? There's no need, I think.
When you exit, is there a charge every time you exit?
So the great thing with the likes of ActivTrades, if you notice, let me go back to one of these. Oh wow, it's quite a bit. Here we go. Yep. You already have the PDF deck of them as well.
Oh, really?
Yep. So yeah, more than happy to do that. So what you see here is 2 different prices, a buy and a sell price. Do you notice there's a small difference between the two? This is what is known as the spread, hence the word spread in spread betting. So there's a slight additional, let's say, what is known as referred to as a spread or difference between the 2 prices. That essentially is your cost in the trading. So for buying, let's say, 1 share with this, the charge will be about 30 pence. Where if you compare it to traditional US stock market trading, you're paying about $15 to $20 to buy and then $15 to $20 to exit. So a round trip, which is what it's called, you're paying anywhere from $30 to $40, which if you're only making $30 to $40, you're paying all the way. So that, again, one of the major advantages of why we use this type of broker. Keep your money safe, keep it tax-free, lower barriers to entry. It's just the perfect scenario for a beginner to begin with.
Is there such a thing on the system of an ISA-based account which you can effectively self-trade so it's tax efficient? Well, would it be any advantage actually?
Between the likes of spread betting and ISA,
No.
not really in terms of the tax elements.
But from an investment account standpoint, in other words, if I'm not spread betting, if I'm investing, and I did that within an ISA-based account, can you trade through an ISA-based account?
You can.
Through ActivTrades?
There is, not for ActivTrades, there is other providers there, but let's say some of the advantages like split shares are not available, so your...
Does everyone understand split shares? Yeah.
So it could be higher amounts of money you need. The range of markets will be less, so you can't invest into all the things that ActivTraders has.
ActivTrades is quite a wide range of...
Yes, so in terms of the tax benefits, spread betting really is a bit more of an advantage because of the range of markets there, as well as the additional help with the insurance that you have when you grow a much larger pot size, and then the partial shares elements for someone on a smaller pot size. So far more benefits there, as well as then you could end up meeting your ISA threshold and putting that 10, 12,000 pounds in, and you can't put any more in where you have more opportunities. So that is, again, a bit of a limiting factor. But once you're a seasoned investor, do I have an ISA investment account? Yes. Why? Because might as well. That's really what it is. So to utilize all brackets and safety loops that you have, you might as well. Okay, so what we're going to do now is go through a lot more of a practical element. So guys, even if you don't have your account set up, what you can do is, if you follow me here, which is just going to the website address activetrades.co.uk, and you go down to platforms and click on Active Trader, so this one here, what you'll see when you do that is that the next page allows you to have the option of opening the platform. So let's see what happens when it does it. It might ask us to log in, but we can do it again if it does. There we go. So just taking you through the steps once again. Once you're on the home page, go to Platforms and click on Active Trader. So that's Platforms, Active Trader, and then you can click on Open Platform, which should open up another pop-up. And what should load, please let me know with your hands if it doesn't. But what you can see here is a demo account, which, as I said, will expire in 3 days, so 72 hours. So you get a dummy £10,000 to be able to play with, to get to use of the actual platform. And
Where did you go?
yeah, no problem. Once you're at the home page, go to.
So I don't know, my husband stopped me in this one. So.
Let's see, you're already logged in. So what we can do is actually access your platform here.
Okay.
Which might just need to log in again. And yeah, there we go. We're already there then. Anyone?
Can you show me,
Yep.
show me how you got there? How'd you get there?
So access platform.
Okay, that's it. That's
That's
the main
it.
place you want to go when you log in.
Yep.
Okay, thank you.
Okay, so this is your platform that I want you to get a little bit more accustomed to. What you realize is the charting software that we are using, which is called TradingView, we pay for that service. But the benefit, again, one of the other benefits of using ActivTrades, they implement that same charting software, so without any fee for you as well. Most importantly, the charts look exactly the same as what we looked at, although on a black background, where you can change that to a white background if you liked. And importantly, the measuring tool is there on the left-hand side as well. So, I'm going to stand on this side. The measuring tool here is the one that you use. Is that the ruler? That's the ruler, yep. And let's just show you a reminder of this. Once you click it, you'll notice once you click it, it's activated in blue. And then anywhere you are on the chart, you then just click and let go. And just by moving the chart around, you'll see it starts to measure the movements and percentages for you. So that's the measuring tool. I'm going to then teach you how to find the right asset. So at the top here, and this is just a bit of a default, but it's using the Euro-US dollar, which is a Forex pair. So what we want to do is click on Euro-US dollar at the top. This is essentially what is referred to as a symbol search. So this is where we'll find the stocks that we want to take a look at. So we go to Euro-US dollar and click on that, and you have something called a symbol search that pops up. So we can then start to type, let's say for the example of Apple. And you'll see Apple US, Apple Incorporated, the share comes up. Importantly, if you click on the result, you then get a daily look of Apple shares. Now, do your charts look the same as mine and have a bit of an annoying histogram at the bottom? Yeah. What we can do, we don't need to utilize this. That is something known as an indicator. So we can remove that from the chart. The way we do that, at the top, you'll see something called volume SMA. As soon as you go to the term of that, you'll see an X button there. So there's one or two things. Either we can press the X button, and that will remove it off the platform. If you also click on the I, you can make it non-visible. So it can be interchangeable if you show it or not. As you're never going to really need it, you can click the X. And that's purely just to make the chart cleaner. Is there a question? Yeah, so just to get rid of that. Yeah. Oh, wow. You have something different in your chart. Let me take a look at that. Oh, wow. Let's come out of that. Okay, yeah. So because we were just in the measuring tool, that's why it came up there. So we can either hide it like this or just remove it off like that.
Okay. Thanks.
Welcome. So what we are able to do now is search any of the stocks that we wanted to get into. So for example, the two that we liked, Disney and Nike. The simpler of the two was Disney. So we can look at that one first. You notice that it looks exactly the same. The default setting over here of daily charts, exactly as you want to keep it, so nothing needs to differ there. And we can use the measuring tool once again to look for that opportunity. So if we go from the drop-down list there, all the way down, we see the same information that we saw earlier when we looked at Disney, that from the highest point it's been over the last 12 months, it's fallen by 21%. Now, what you'll find when you start to play around with your charts, which is captivating a lot of you right now, is sometimes the zooms can change things. What I want you to do is almost, yep.
I've got two bars on mine suddenly.
Yes, good, because what I want, you got two bars. Oh, two charts, lovely. I think you maybe done an overlay onto this. Let's see what you've done. Ah, yeah, you have Disney on top of Euro. So basically we can just take that chart off. And if we click here and put in Disney into this, and then click on that, that will then just bring up the one chart for us. Now, what can happen, I'm just going to show you an eventuality if you start playing around with things. Sometimes you'll find that you may be zoomed in, let's say. So the chart might look like this, and you're not sure what's going on. A simple process, when you're on the chart, right-click and go to Reset Chart View. That will always bring back things to the norm and allow you to refer back to this. The other cheat that I want you to see is right at the bottom of your chart. Do you see that there is a couple of terms that you might be able to make sense of? It says 1D, 5D, 1M, 3M, 6M, 1 year, 5 year, and all. That, if you click on any one of those, it will show you that amount of data on Disney. So remember, with the AI strategy, we're looking at how many months of data to look at the highest point? 1 year. So we can just click on 1Y. So if at any point in time, if we're zoomed in for whatever reason, and it looks like this, for example, if we click on that 1 year, it will always reset it back to that 12 months worth of data so that we can see where the highest point is and then use our measuring tool.
And how did you set the alerts again?
So with alerts, this is the one sticking point you'll find. The alerts will be found on TradingView. So you can have a free TradingView account and you can put an alert in that way, but there's no alerts through ActivTrades charting software in this way. If that's changed, let me see. No, there is no alerts for this way. Now, this is also why we do a lot more in terms of weekly newsletters. So every Sunday there's a weekly newsletter that's sent out which talks about the opportunities that we're looking at. So you can always stay on top of things with a Sunday newsletter as well as the Wednesday webinar, and you see what stocks we're getting into. Because essentially, if we're getting into a stock, you know that it's hit the criteria of that, so you can start to look at that in that element as well. Right, the other thing I wanted to show you is, now the market is closed for today. But let's say Disney is that stock that we looked through the 5 steps. We know how much we're going to be investing. We know that it's fallen by 20%. There's 2 digits you'll find at the top over here. One is a buy and one is a sell. Doesn't really matter which one you essentially click on. It should, and normally would bring up a ticket, but what you can see is it's telling me and reminding me that the market is closed. So what will happen when we do click on the green button here, which is the buy at market, what will happen is that it will show us a order ticket which looks exactly like this. So the order ticket will come up like this, allowing us to change the amount of shares that we want to buy. And remember, that could be any decimal point. confirm the margin number is the amount that you wanted to invest, and then you can click on place the order. Straight away what you'll see at the bottom of your charts, you have what is known as positions, orders, which you likely won't have at the moment. Positions being any stocks you're currently in, and history. So you'll see anything you come out of afterwards as well. Now, all of this type of information, like the history, etc., you can download. So if you want to do a further dive into your positions after the whole year, look at it into spreadsheets, etc., you're more than able to do so. But remember, at the same time you're doing all this information here, you're going to be utilizing the average index calculator from our website as well. So use that as a journal. As you also go on, you can actually start to formulate. This is essentially over here, you can see a number of different markets. This essentially is a watch list. So you can start to formulate your own watch list. Let's say, for example, it would be Disney and Nike into this right now. So we can actually add it in by searching on the left-hand side where the symbol list pops up here. So press on the magnifying glass. You can then search for the stock. So let's say Disney. And if we click on the plus sign here, you'll see that the plus sign turns into a tick. And we then click on done, and that will then be in your watch list. So you see at the top now we have Disney here, and it's now part of the watch list. And that's just keeping a bit more efficient. But you can see how now that we've gone through the process of finding two opportunities in Disney and Nike, and across the other couple of stocks we looked at, they're not ready just yet. We streamline our process. We know what we're going to be doing for the very next day, maybe the next week. And the rest of the time is essentially looking for new opportunities. If there's nothing there, sitting on our hands, enjoying the rest of life and spending time on other things, essentially.
So the calculator isn't on the ActivTrade, that's in another...
That's what we have created, yeah. Which is exactly where we're going to take you to now, which is our homepage. So if you go along to becomeatrader.com, that will allow you to sign up for, again, a free account for access to our courses, which will start from an even more of a basics than what we covered today, which is our foundations course. You'll then have also access to the entire investing course as well, and then the resources of the downloads. So just click on the sign up, which is just going to be an email and a password set up for yourself, and then you'll be able to enroll into the foundations course. So what you should be able to see when you go to, if you go to all products, once you've signed in, you'll see all of the list of courses. Now, when it comes to the investing and trading courses, once you're ready to jump on board with that, so your accounts are all set up and funded, let us know and we'll give you access to that. And what you can enroll into right now is the foundations course and the support course. So I'll take you through the two elements there. But if there's any questions in regards to signing up or actually enrolling into it right now, if there's any questions, please let us know. We'll come and help you with that. And the support. Yeah. They're the ones you can begin with right now. And once you basically have your account set up and you're ready to take some action, we can unlock the investing and trading courses for you. So essentially, yes. So essentially, just get in touch with us once you're ready for that point, and then we'll be able to enroll it for you there. So we're just ensuring the right flow for everyone to go through, rather than enrolling to everything and having information overload.
So once you've done those two course studies, then you open the trading account, is that what we're saying?
Well, the trading accounts are pretty much should be halfway open for most of you in terms of that confirmation. Maybe some extra information may be needed on the KYC aspect, but that's essentially open. If you want to dive into it straight away, by all means, once it
Two courses, the foundation, the support, that gives you access to what? Sorry, then.
The access to the investing and trading course, essentially, once you have your account set up and funded, get in touch with us and we can unlock it. In terms of the progress of learning, we still recommend you going through the foundations course before going to the investing course. And when it comes to the support, that is our webinars. So that will give you the resources of all the last weekly webinars we've done and what we discussed on them. And the link will be emailed to you as well. So by signing up for free account and Become a Trader, you'll essentially every Wednesday be given a link allowing you to join the webinar for that evening. And if you're not able to join for whatever reason, the recording will be up, if not that evening, the very next morning.
Was the foundation course and which is the support course? Is that called the investing course?
No, it's just called support. So if you can't find it, click on all products. And yeah, Rishi's coming behind you. So within the elements of this, that will give you all the access to what we've covered, the resources that we showed you, the compounding calculator and the AI average index calculator journal, as well as the recording webinars there. And as mentioned, by signing up here, this coming Wednesday, you'll see an email from us in regards to your link for the webinar for the evening as well. Any points I missed with this, Rishi? That's right. Any issues with anyone finding these elements or signing up? That was absolutely fine, right? Fantastic. So I'm just keeping an eye on the time, guys. And
One question that was asked on the stream, sorry.
Yes.
Can you trade using a different platform apart from the one being advocated here? Obviously, this makes a lot of sense because you're very familiar with it. I understand you're not going with this.
The only suggestion that would really be on that aspect is if you are an experienced investor already, you know what you're doing by getting into the market. So if we say in the webinar, we're getting to Disney, and this, you're able to implement that on your own broker, not need any hand-holding that way, absolutely fine. The key thing here is that most people are doing it for the very first time, and therefore we're utilizing a platform that we can take you through exactly, because every single broker would have a different but also a different range of instruments as well. So they might not have all the stocks or the ability of fractional shares, for example.
Also, if it's another broker, we won't have any control over it. So if you have any queries with the broker and it's not active, yeah, we can't be involved with it.
Fantastic.
Yeah.
Covered most of the ground.
Yes. Like, for example, we did have one of our most active investors, actually shouldn't be, but is a full-time doctor who's massively active investing, and he wanted some extra stocks put onto it. So it's literally a call by us to say, can you add these instruments onto the market? More than happy to assist as well.
And then having done this course now, what would be the next step from here in terms of training? Is there another course we should do, everything can happen online?
So essentially the investing course will actually go a little bit more, quite a lot more in depth than what we've touched upon here, allow a lot more of the practice elements as well.
How long will that take to do in its entirety?
The course shouldn't be anything more than 5 to 6 hours, but in regards to going through it, can easily be done over 2 to 3 days, over a week maximum, depending on how much time you're available for it, because there will be some aspects of repeat, but no one video should be more than 25, 30 minutes, unless it's a bit of an example video or something like this. Yeah, and you'll see the progress as well as you go through it as well. We can also see your progress if you need any help on certain elements. Beyond that point is once you're implementing this and getting great success with it, if you still want to level up, the trading course is there as well for you to then dive into understanding a lot more about the markets, the fundamentals of the market, what drives it with supply and demand, essentially the buyers and sellers in the market. And once you understand that, you start to understand a lot more about any asset class.
So when we want to put the money into the ActivTrades to start, how does the ActivTrades know that it's linked to your, because obviously you want to get your...
So we have no idea what your account is, how much money you put in, etc. So it's literally a case of, Avi, Rishi, I put money in my account, I'm ready to start, I want access to these courses,
Okay, so we
email
just
us.
tell you once we put money and then...
Yeah, exactly that, yep. Now, in regards to the next step, so exactly what we kind of touched upon here, which is funding your account, starting your learning on that aspect, opening the account up there. Oop, was there any of the bit? Nope, that's all. And then again, guys, so this event here was fantastically organized by Daniel, which also came from another networking event that we had in previous community class that we had. And I believe it was Mansi who works with Daniel or works for Daniel, who spoke about this, and that's where this opportunity came here. And we'd be more than happy to do any refreshers with this. I think, as I was saying to Daniel, sometimes these aspects can be a bit of a litmus test to see what the feedback is from those in the community. We'd be more than happy to repeat some courses here. Of course, happy to do some things online from the comfort of that as well. So if you also have some community on outreach or someone that you want to, let's say, hear what we have to say or be able to do this, feel free to get in touch with ourselves. We'd be more than happy to try and accommodate and work something through as well. Thank you so much. Thank you. Thank you very much, guys.
When you take out the money from the trade,
Yes.
how quickly does it actually physically come back to your bank?
Within 1 to 2 days. So because it's, again, UK law, your money is put in segregated bank accounts, so you know exactly where your funds are. And generally, if you've done it by debit card, you'll be coming back by debit card, or bank transfer, be coming back. So within 1 to 2 days, it should be there. Oh, good. Perfect timing. Any further questions? And I'm sure, guys, once you actually come to the actual application of it and the implementation, there will likely be some questions. We'd be more than happy to assist you via email support and, of course, on the webinars where it's live and we can actually see some opportunities live as well. Feel free to partake, ask as many questions as you want.
Yeah. Just want to say thank you so much.
Thank you very much, Daniel.
People who left were just outstandingly positive about it.
Yeah, and we understand that the time aspect of this,
Yeah, people are so grateful.